China's big on hydrogen, Australia's very big on hydrogen, Japan is blending already hydrogen. So I would say the world is now really focused on this because it's the only way to store energy for a long period of time economically is to convert it into either a liquid or a gas.
And of course you talk about the price, but the other big component is the volume. You know, how big can you go? Where do you see that on a time scale?
So wherever it's sunny or windy, you can produce very cheap hydrogen eventually. And so compared to oil and gas, which are concentrated in few parts of the world, it's going to be very democratic from that point of view. So every sunny place, every desert, every ocean wind can be turned into hydrogen that we can put on ships, in pipes, and really start trading it around the world. So it's going to happen a lot faster than a lot of people think.
So, and when you say a lot faster, what is that in time?
As I said, $50, which is essentially oil parity within 5 years. And then, depending on how quickly we ramp it up after that, we could get to $25, which is coal parity before the end of the decade.
And in big scale.
In big scale, because once you get to coal parity, that's the only way we're going to get China and India to stop burning new coal. We have businesses in China and in India, and I see a lot of hydrogen development, a lot of renewable development in both countries. The India announcement was incredibly strong on 2030. Some people were upset about the 2017 net zero deadline, but when it comes to 30, he announced a big commitment to get to 50% renewables.
Were you surprised by it?
I was surprised that they would make it so explicit, and even the net zero is a big thing for them. And so I think it will happen faster than 2070 because of the falling cost of renewable and hydrogen. India's burning 80 gigawatt of oil, of diesel, to keep the lights on. So there's an immediate opportunity there, and we're very interested in working that country.
And with regards to China, perhaps the fact that we haven't really seen them active, I guess the diplomats are working on this, but we haven't really seen the leadership.
It's going to be technology, it's going to be industry. I think China has committed to a net zero, which is very important. At the G20, China was clearly behind the 1.5 degrees. So I think a lot has been achieved between the G20 and COP, and I think what's really important is to see in the coming years how quick. It's in our hands to make part of this happen in 5 years, or it could otherwise happen in 15, 20 years. It's about building the project. The capital is there. We saw how many trillions of dollars are already committed. What's missing is really the projects, and that's where companies like us step in.
Marco Alvera, CEO of SNAM there, speaking with our Maria Tadeo. Let's turn now to the aviation industry. It's a big contributor to global greenhouse gas emissions, and it's under pressure to change that. In October, the International Air Transport Association, a trade body representing airlines, approved a target of achieving net zero emissions by 2050. To achieve that, many airlines in the US and Europe are looking to buy sustainable aviation fuel made from renewable sources like used vegetable oil. Initiatives like these are pushing plane makers to come up with some radical new aircraft that will eventually cater to our growing appetite for travel without hurting the environment. We took a look at how Airbus, the world's #2 aircraft manufacturer, is stepping up to the challenge.
How long until we can fly emission-free? Airbus says it's more confident by the day it can be done by its 2035 target. Airbus's CEO spoke about its ambitions for hydrogen-powered planes at the company's summit in France.
The physics works. Hydrogen technologies are not new. They are used in other sectors. We use them in space on our rockets, and we don't need the laws of physics to change to be able to use hydrogen on our planes. So every day we become more confident, but we think we need to have a plane, we need to have the right fuels, the hydrogen available in the right quantity at the right place at the right time, and we need the regulations to be ready. So we really need the work and the collaboration of many people around the globe to make it happen on time.
But it could be a long wait until green passenger jets go mainstream. Larger aircraft with more than 150 seats are not expected to feature globally until about 2050. That means manufacturers and airlines today are under growing pressure to ramp up short-term innovations to cut their carbon. In the long term, meeting the ambitious plans for so-called green hydrogen means building a giant industry almost from scratch. To make that happen, British airline EasyJet is among those saying governments need to get involved and fast. Aviation's emissions over the last 3 decades leading up to the pandemic grew by about 80% to over 1 gigaton, and that's projected to double by 2050. According to Bloomberg NEF, about half of the airlines with the largest global market share have set net zero targets by that same date, nearly 3 decades away.
Coming up, from blue sky projects to the bottom line, we'll speak with our Bloomberg NEF expert Meredith Annex and dig into their models about how hydrogen fits into the future energy mix. This is Bloomberg Green. From Bloomberg's World Headquarters in New York, I'm Kaylee Lyons, and this is Bloomberg Green. Now let's bring in Meredith Annex, our Bloomberg NEF hydrogen specialist, to talk more about how hydrogen could change the energy landscape. So Meredith, what place do you think hydrogen is likely to have in the future energy mix globally?
Hydrogen's this incredible solution for us as we look to decarbonize because it's a perfect solution in areas that are hard to electrify. So where we like to think about hydrogen playing a role, it's in things like heavy industry, especially where you need a feedstock as well as energy source, and in things like dispatchable power, long-haul transport, maybe even shipping and aviation.
That sounds great that it can be used for such diverse industries. At the end of the day, though, how much is this going to cost?
Well, that's the amazing thing about hydrogen, because depending on how you make it, it can actually see significant cost declines in the future. So when we're talking about clean hydrogen, we usually mean green hydrogen produced from renewable electricity. And in that case, your hydrogen is almost as cheap as the renewables that are used to make it. So if you're in a place with really good renewable resources, you'll be able to have cheaper hydrogen. But even in places with less good resources, we think that hydrogen can be cheaper than $1 per kilogram, which is the price of unabated hydrogen today, and around $8 per million BTUs for those who prefer to think in energy units. And that can be achieved anywhere in the world by 2050, we believe.
All right, so let's talk about kind of the pros and cons list. I don't know where cost fits into that, but what are the advantages to hydrogen over other renewables, and then what are the drawbacks?
Yeah, main advantage is the fact that hydrogen can serve roles that electrons struggle with. And that's things like seasonal storage, for instance, or just anything where you need storability, where electrons are harder to store, hydrogen is going to be easier. That also leads to a downside, though, because hydrogen is less energy dense than the usual things that we use for storable energy today, like coal or oil or natural gas. So you will need more volume of storage to handle the same amount of energy.
Let's talk about the viability as well and how it may differ in different geographies. What is your view on that?
Yeah, so for green hydrogen, again, from renewable electricity, really places with the best renewable resources, things like Latin America or the Middle East, even Southern Europe, have really, really good potential for producing hydrogen. And then when you're looking at blue hydrogen, which is produced from natural gas or coal with carbon capture and storage, we do see that becoming more expensive than green hydrogen in the future, especially as renewable electricity costs come down. But that can be a viable option in places like the US Gulf Coast or Russia, where you've got good geological storage for the carbon, as well as ample natural gas that's quite cheap.
All right, great breakdown. Thank you so much to our Meredith Annex, our Bloomberg NEF hydrogen specialist. And of course, you can get more from the Bloomberg NEF team on the terminal and online. And they've recently done a podcast called Hydrogen 101 as part of its Switched On series. So from iron ore titans pivoting to cleaner energy to talk of a hydrogen revolution, that's it from this week's edition of Bloomberg Green. We'll be back next week with a deep dive into the state of electric vehicles. And you can keep the conversation going by following us on YouTube, Instagram, and Twitter @Climate. I'm Kaylee Lyons from Bloomberg's World Headquarters in New York, and this is Bloomberg Green.
The great sci-fi art of the mid-20th century teased a vision of the future with one distinct element in common: a life for humans in outer space. Whether vacationing on an exotic new planet or commuting to the moon for business, space travel seemed like it was just around the corner. Yet here we are, a half-century later, and only about 500 human beings have ever left the bounds of Earth's atmosphere. But thanks to a set of ambitious private companies betting on the promise of space tourism, that long-awaited future could be here sooner than we think. For most of the history of spaceflight, governments have been the prime force behind nearly every aspect, from planning to funding to crew selection. But as early as the 1980s, proposals for commercial space tourism began to emerge, along with innovative solutions for getting people there, such as the wild concept of sticking a 74-person passenger cabin in the cargo bay of a NASA space shuttle. Although various non-astronauts have been selected for missions over the years, true space tourism didn't happen until 2001, when an entrepreneur named Dennis Tito coughed up an estimated $20 million to hitch a ride with the Russian Federal Space Agency for a week-long vacation aboard the International Space Station. 20 years later, we're seeing a new contender in this final frontier of tourism: private companies.
It's becoming a private enterprise situation, still very high risk with a high reward, potential reward. But, government is really out of the business of flying people now, and it's really going to be companies like Elon Musk and Jeff Bezos and Richard Branson that do that heavy lifting. Commercial space tourism is usually about taking the non-astronaut, the private citizen, into an orbital or suborbital flight. So you get a short amount of microgravity experience, and you can float and take some photos. And then you come back. This was something that technology had gotten to a point where the private sector was going to make a business out of this. There are multiple companies that want to get to the place where they fly people into space.
The first of these is Blue Origin, founded in 2000 by Jeff Bezos. Using the autonomous rocket system New Shepard, a tribute to the first American in space, Blue Origin plans to launch up to 6 passengers at a time, offering a rarefied treat of 62-mile-high views and a momentary experience of weightlessness. Booking officially kicked off in May 2021, with the very first seat to be auctioned off for charity. Meanwhile, Richard Branson's Virgin Galactic has also been pursuing a viable form of suborbital tourism, aiming for a launch in 2022 once Sir Richard himself has taken a flight.
I'm hoping to be able to go to space. I'd love to be able to coincide it with the moon landing and go to space. So I've got the whip on the team, and we'll see how we go.
The company claims to have lined up over 600 seat reservations so far, including Justin Bieber and Leonardo DiCaprio. Virgin has projected that the final cost of the ticket will be at least $250,000, or roughly $50,000 for each of the 5 minutes or so of weightlessness that you'll get to experience. Although costly, both companies' offerings aim to make suborbital flight a regular form of adventure travel, eventually driving down costs at scale to expand the customer base beyond the orbit of celebrities and billionaires. The third major contender is Elon Musk's SpaceX, which has set its sights even higher on orbital flights, which are
a whole nother level of complexity and energy and danger. When you go suborbital, if you're just going to go up above the von Karman line, which is 100 kilometers or about 62 miles, you only need to get up to maybe 5,000 miles an hour to get up there, and you go basically straight up and then straight back down. You don't have the reentry heating that you would see coming in from an orbital. So when you go orbital, I don't care if you're a baseball or a battleship, you've got to go 17,500 miles per hour, not just 5,000 miles an hour. The energies involved are much greater. By doing that, SpaceX has gone another level up, and that's what they're doing with the Inspiration 4.
Visit inspiration4.com for your chance to go to space.
Inspiration 4 is the first planned all-civilian mission into orbit, slated to launch in late 2021. The crew will bring their own set of diverse perspectives and backgrounds and experiences to test how a group of different people, namely people who aren't professional astronauts, could fare in space.
Until now, astronauts have had to be physically perfect, and this mission is changing that. And so I feel incredibly honored to be representing those who aren't physically perfect. At age 10, I was diagnosed with bone cancer, and I was treated at St. Jude Children's Research Hospital. And I spent a year there undergoing intense chemo and also surgery that ultimately saved my leg. I now work at St. Jude as a PA, a physician assistant, and I work with leukemia and lymphoma patients. The kids we work with are so brave, and they are very excited to watch me go to space because this is showing them that, they're capable of doing this as well.
Haley, along with 3 other crew members, will spend 3 days in space, orbiting the Earth every 90 minutes before landing back off the coast of Florida.
Well, when you think about access, the first astronauts for the United States came from the test pilot side. And so women weren't allowed to be a part of that. We have somebody in their 20s, somebody in their 30s, somebody in their 40s, and somebody in their 50s. And so there can be access in all kinds of ways, whether you're talking about age, whether you're talking about gender, whether you're talking about race and ethnicity, and all of those things.
The first time, people are going up into space and not sent there by a superpower like the United States or Russia or China. Well, that's really significant. And you've got to be very thoughtful about it. The whole game plan right now is to make space really affordable and accessible for everybody, so that you can have fishing buddies going to space someday. But the first is special, and so with that, we wanted to have a crew selection process that could make space available to everyday people.
Getting to space is only the first step for space tourism. The next challenge is what to do and where to stay when you get there. Axiom Space is planning to launch the first segment of a new commercial space station in 2024. Their $2 billion project, called Ax Station, will become the first free-flying private international space station. Or, to use a more consumer-friendly term, a space hotel. Axiom isn't the only company out to make your space stay a little more comfortable. Bigelow Aerospace has been building what they call expandable habitat technology, like their B330, an inflatable pod module that expands once in orbit.
There's even one attached to the International Space Station right now they've been testing. And you take it up and it's rather small, and then you inflate it, and it seems to be working very, very well. This is likely to be the first kind of tourist hotel that you're going to see up in space. First of all, it's easier to carry instead of this giant tin can with all of that. The inflatables are lighter. You can just blow them up, and they get a nice big size for about less than half the weight probably.
But even as space missions become accessible to civilians,
the risks of going into space are incredibly high. And you could die 1,000 ways that we can think of and 1,000 other ways that we can't think of.
this is Michelle Hanlon. She's a space lawyer at the Mississippi School of Law, focused on protecting humans in outer space.
Now, I'm not an attorney for any of the space tourists, so I haven't been privy to their private contracts. But I can tell you that the FAA requires certain waivers. All the ways you can die in space. And you have to understand that there's health risks, and you have to indemnify the US government if you are launching from the United States. So those are things that we know a space tourist has to sign and has to waive. So now let's go back and think about our space flight participants. The FAA calls space tourists space flight participants. They don't call them astronauts. Why is that important? If you're not an astronaut, there's no obligation to rescue you if something goes wrong. It's a lot of money to set up a rescue launch. If it can even be done, it's something really important to think about, and that difference as we cross this threshold from having astronauts in space to having real people like me in space.
And when we are able to make it to space reliably enough, there's still a host of other legal and ethical issues to consider before space tourism can truly take off.
There are so many gaps in space law that we are going to have to put in a lot of sort of basement ideas. And so, for example, the Outer Space Treaty is a treaty that offers principles and guidelines for state activities, for the activities of national governments. It doesn't talk about private entities, it doesn't talk about humans in space. So now if something goes wrong, so let's think about all the times hotels on Earth are sued, right? So slip and falls, you step on something in the bathroom, you sue the hotel, and it becomes a private lawsuit. Because of the vagaries of international law, if something happens in space, well, boy, you can sue the state that launched your spacecraft, you can sue the company that brought you there, you can sue the hotel, you can sue the individual, you can sue every government related to that, because the way the Outer Space Treaty and the Outer Space Regime have set this up is that anything that happens in space first has to go through a diplomatic channel before you think about suing in a court of law. And so every single slip and fall in a space hotel is a diplomatic nightmare. And so we really need to figure that out before we start sending a lot of people there. You think about human rights in space. Here, we don't think about a human right to oxygen because it's kind of all around us and free. It's not in a space hotel. So what happens if something happens and the oxygen depletes? Who gets the oxygen first? And then, of course, let's not even think about the labor. How do you treat your labor in a space hotel where that person may be there for 2 or 3 years without coming back to Earth? So a lot of things to think about.
Space habitats are more likely in the near future to focus on research missions and be a home for experiments that can't happen as easily back on Earth.
Space hotels, I think they garner a lot of headlines and a lot of news, but at the same time, that's not the first thing that you're going to see happen. They don't offer the compelling business case, I think, that you'll see from a place that wants to manufacture pharmaceuticals or a new type of crystal or some type of filament or fiber optic cables and other things that you can do in microgravity. The things that are actually, a high value finished good, when you get that back to Earth and you sell it for a very, very huge profit margin, that's what's likely to happen in space, as opposed to having a real estate platform that you sell to a tourist. A space hotel is really interesting, and it will probably happen, but it's not likely to be at the forefront of space commerce.
Even if space hotels are right around the corner, don't get too excited about booking a trip in one.
It's not a cheap ticket to ride to space, and it's going to be, millionaires and billionaires and that sort. But at the same time, the point was made that in the early days of airline trips, that was also a completely unaffordable ticket for most people. Those people who flew were people of means, and over time it becomes affordable to the masses. And I think that's the goal for all the entrepreneurs in space as well, to get those costs down to a point where it's not $10 million or $5 million or $300,000 ride into suborbital space. When it becomes more like buying a first-class ticket to go to Europe from the United States. So that's the goal, and the question is, can we get to that point?
Given the immense operating costs of getting to space, it may be years, if ever, until space tourism becomes a profitable venture for any of these companies. Virgin Galactic, the only publicly traded company of the three, has had a particularly rocky year, initially riding on the momentum of a SPAC deal, but more recently beset by launch delays and major funders, including Branson himself, selling large quantities of their stock in the company.
Space is really, really, really hard, and it's an absolute cliche, but it's one that happens to be very true. It's just really hard to do. That's also the reason that you've seen the delays that, Virgin had talked about flying years and years ago. And it became such a crazy point that Richard Branson actually stopped talking about it when he was asked, because it was never going to be when he predicted. But it's not insurmountable. And, investors have stepped up because this is something that is doable.
Despite the astronomical dangers and costs of getting to space, it may ultimately follow the course of other once fanciful modes of travel.
Wright brothers having, what was by modern standards a very unimpressive first flight, at Kitty Hawk. I mean, you had like less than 20 years later, you had your first airborne ambulances being used to save lives. Fundamentally, the world is a more interesting place when people can go and dance among the stars and such.
The lure of space is innate. It's in our DNA. It's that exploration bug. We are an exploratory species, and we want to go out there and see what's out there.
That vision that I had in 1969 of seeing normal human beings travel into space, it's finally beginning to happen. When you get a bunch of people up there and they can all see it for themselves, that'll create even yet another revolution in how we treat our planet and the way we think about it.
So while 2001 came and went without quite looking like Stanley Kubrick's ultimate space fantasy, 2021 might finally be the year we're catching up.
If you visit California, you might be inclined to go to Disneyland, or jump in your convertible and take Highway 1 up the coast, or maybe make a pilgrimage to Yosemite. All very fine choices. But if you're the kind of person who revels in our planet's extremes, then it's Route 395 that you're after. This one glorious road will carry you from Death Valley's desert floor to sky-high views of Mount Whitney. You can see the 5,000-year-old bristlecone pines, the oldest living organisms. or the bizarre Tufa Towers of Mono Lake. And true to California's boom and bust spirit, you can saunter around the ghost town of Bodie. What a novel experience to find an empty American city where all the businesses are shut down. To do 395 upright, it helps to have a guide, and mine is a man named Jan. And his crew, Heron,
Let's tidy up first.
and Lemmy, the hardest partying dog of all time. Jan agreed to show me some of what 395 has to offer, but only if we agreed not to disclose any locations.
My name's Jan Srostra. I'm an industrial designer out of LA, and I spend a lot of time camping and a lot of time in the Eastern Sierra. It's a place I love, and sometimes I'm known as 395 North because my Instagram account, and I don't like to be known as that, but I'm trying to use it to set a good example and do more with it than just social media.
Where did we end up camping? We got here late last night. I wasn't even sure where we are.
This is BLM land, right on the outskirts of National Forest, and it's one of my favorite places in the world. Basically, everything outdoors wrapped into one.
Yeah. Good thing about California, man.
Oh, man. We have so much national forest and public land that you can literally just cruise out and find a place to camp. It's ours.
What I wish was mine is Jan's sweet truck.
It's a 2019 Ford Ranger. Has about 200 watts of solar in it and a fridge, and has everything that an RV has except for a toilet, but just on a smaller, simple scale.
And you drive us around day to day in LA.
Yep.
And then just roll out when you want.
It's my daily driver. Handles great. And then when I'm done with work, I can just bail and go camping. So the camper basically has only what I need. Think of it as backpacking with a car.
Yeah.
The fridge has a couple compartments. This is just a kitchen box, stove, utensils, and a bunch of stuff. This one has just dry food. Then when you get inside, there's a bed. The bed flips up, so you've got tons of room in here. This awning is phenomenal. If you want to pull that over.
That's cool.
Let me just pop that up.
Sorted.
So, home on wheels.
Yeah.
This is my vacation house.
Dude, it's so nice, man. Even with his nomad lifestyle, Jan faces the same big question as the rest of us. Do the internet and smartphones have to ruin everything? When you find the super special, beautiful spots, is that you busting out a map and like looking where it might be cool to go, or is it word of mouth and just getting to know people, the locals? And
if I see a dirt road, I just want to go down it. So a lot of it's just aimless rambling. It's a desire to just see something. Check that out. For some reason, it's more fulfilling than getting a recommendation from somebody. Or there's tons of apps and websites now, road trip apps, camping apps. They've proliferated. The knowledge is accessible on the internet, right? I used to fight the geotags, and I would get really pissed off. Like, why are you posting this place? It's gonna blow up, it's gonna get trashed. Now I've realized that you can't fight it. The internet has just shrunk the world. So we're not gonna stop it. We're not gonna stop people from going there. So I'm a lot more focused in conversation now with trying to set a good example. When you go, pick up your trash. When you're pooping out in the wilderness, don't leave your toilet paper on the top. Make sure you follow, good steps for leaving no trace.
as a thank you for this quick guide to pooping etiquette, we made Jan, Heron, and Lemmy some tacos. And we all took in the night sky and knocked back a couple of drinks. Take that, Apocalypse. The thing about good times and serenity in 2020 is that they're fleeting at best. After we split up from Jan and continued on our way, smoke started to envelop us. The plus side was that our RV no longer smelled like feet. The downside was breathing. My man David here suggested that we try and outflank the smoke by cutting through Yosemite. Without a reservation, we had to talk our way in.
Yes, no stopping, no getting out, and yeah, no problem. We just wanted to get through.
It was a beautiful choice.
Glad we got out of the smoke.
Whoa, okay. But not quite as effective as we had hoped. Fast forward 4 hours or so, and we had managed to trade the smoky majesty of Yosemite for the smoky, look at it, strip malls of the Central Valley. We have made it sort of out of the smoke, all the way across Yosemite National Park and here to the gorgeous Central Valley of California. We're off to see a kind of surprising tech startup that is making some pretty strange machines to serve all the growers out in this region. And we're here in this near Fresno. This is California farm country, right?
We're just south of Fresno, a town called Kingsburg. So we're right in the Central Valley of California. Very, very large farming valley here. It's kind of considered the breadbasket of the world.
The Central Valley stretches out over about 20,000 square miles, and the farmers here produce about 1/4 of the food that Americans eat, including a whole lot of fruits and nuts. Tell me a little bit of the background of Gus. I know some of this is like a family business. The roots of this go back a ways. Tell me kind of like how we got to what's essentially like a startup, I guess.
Yeah, definitely. So the founder of our company is Dave Crinklaw, and he started the business back in 1982. He started with is basically with his dad was commercial spraying of trees and vineyards. Got to the point where our biggest challenge was labor, just the shortage of it, really. He was forced into innovating, and he had this idea for quite some time about doing a driverless sprayer, and it finally got to the point where he said, you know what, I either got to get out of this business or I'm going to innovate.
Organic or not, crops need to be sprayed, and this process has to take place a few times a year. This means hiring a lot of people to work long hours under serious pressure. And so, just like the tech bros to the north, Gus decided to solve all of its problems with robots. On this like labor point, you guys have set this up where you can have somebody in a truck and that one person can monitor, I think like 8 of these.
In order to operate Gus, you have one guy or girl that sits in a pickup and they monitor from a laptop computer. So that person is basically just watching all the vehicles on the screen. They can monitor up to 8 of them at a time while they're out there spraying in the orchard. And so that user interface really provides them with all the information they need to make sure that the machines are safe and that they're doing the correct job. So it tells them what speed they're driving, the engine RPM, the amount of gallonage per acre that they're applying at any given time. So if any one of the machines has an issue, it's going to send an alert to that laptop.
Much like a self-driving car, these beasts use GPS, LiDAR, and cameras to see and navigate the world around them. They also rely on pre-built maps of the orchards for extra guidance. Gus builds the machines right here, and then takes them out for robot training on this orchard next door. It's here that the company learns if the machines will behave and do as their software and human masters command. So this is kind of like this is a test orchard where you guys put it through the paces and work on the technology?
Yeah, so this is our test orchard right here. It's right by our building, as you can see in the background. So every new machine, as it comes off the assembly line, it's put through a commissioning test right here. We test all the sensors on the machine, autonomous computer, all the safety systems, make sure it's doing what it's doing prior to when it's delivered to a customer.
So what's it doing now?
So right now he's doing a test spray. So he's just turning the water on to make sure that the system comes up to pressure, spraying water out of the nozzles just to make sure it's all functioning properly.
Okay. It's got like a crazy turbine at the back, or?
Yeah, so it's basically just a big fan.
Okay.
And that fan's driven off of the Cummins diesel motor, and it just basically creates a big airflow.
Gus is already selling these vehicles to brave modern farmers. And people the world over have taken notice of its machines. And have you just sold them in the Central Valley, or like throughout the U.S., or even overseas, or where are they going?
Yeah, so right now the majority of our machines are here in California in the Central Valley. However, we do have machines and customers in Florida, in the citrus industry over there, as well as Australia.
And I think you started selling them in like December of 2019?
Yeah,
right?
So we started taking orders early last year for the sprayers, and the first deliveries we made were in December of 2019.
Okay,
so.
And how much do they cost each?
So our retail price on these machines is $285,000.
So it's not a small investment, but I'm sure the regular sprayers aren't cheap
Yeah,
either.
I mean, we're honestly not too far away from conventional equipment on our price, and the main thing is that the return on investment is very, very quick due to all the labor savings and the increased efficiency. I mean, these machines, they just thrive. But basically what we're doing, besides this machine, this is our first machine. We call it Orchard Gus, mainly designed for your nut trees, as well as citrus and fruit. In the future, we're working on a few other projects. We're going to do more machines. One of them is actually a vineyard sprayer. So vineyards are much tighter spacing, so the machine has to be physically smaller. And then we've got our eyes on doing a lot of other innovating.
That right there, friends, is a Central Valley farmer putting his whole fruit basket on the table. Gary's TED Talk can't be far off. And with that, it was time to get back in the RV and to confront what happens when three men are bested by their own failings and the forces of entropy. Next on Hello World, we cruise into the Mojave Desert in search of a lunar lander.
We have instruments that we are going to deliver to the South Pole of the Moon in December of 2022. Instruments that are trying to scan the surface of the moon.
And hang with a test pilot who walked away from this.
Meet Betty. She lives by herself, but for the last few months, she hasn't been alone.
LQ, tell me a joke.
Did you hear about the claustrophobic astronaut?
No.
Apparently, he just needed a little space.
Most technology isn't made for 93-year-olds. But this woman is making sure that this particular robot is.
Alicia, who are you?
She's researching the way we interact with machines. And if she has her way, robots will soon be a trusty companion for all of us.
My name is LQ. How can I help you?
As technology replaces old jobs, it's also creating new ones. I'm Aki Ito, and I'm here to show you the jobs of the future.
My name is Danielle Ishak, and I am a human-robot interaction researcher. It's really hard to intuitively design a robot meant for a consumer audience. You have to make sure that it's a robot that people want, people know how to use, and people value.
Danielle works for an Israeli startup called Intuition Robotics. Its U.S. office is here in downtown San Francisco.
Hello?
Hey Danielle, it's Aki.
Come on in.
The company
CEO Brian Moynihan sitting down right now with David Weston at the Bloomberg Sell-Side Leaders
And I can
Forum.
vouch, Mike does do those calls. I'm not on the rotation every week, but every so often he'll call and just say, I'm just calling to thank you for your business, and then we'll talk about something incredibly important to the world that doesn't mean much, but he is serious about that. So.
And he gives you a discount, right?
We pay what we've negotiated, I guess.
So Brian, you're in banking. There's been no shortage of news about banking over the last month, starting with Silicon Valley Bank, Credit Suisse, the earnings, including your earnings, which came out about the last quarter, was very strong. So now that we are where we are, looking back over it, what do we take away from it? Was this a banking crisis? Was it a mild disruption? Was it a tremor? What was it? What is going to linger from it?
Well, I think at the end of the day, a crisis is too strong a word, and words like that get used a lot. But at the end of the day, there was a fair amount of disruption for a few weeks there. Well, certain business models were sorted through, but on the other hand, you could see, and we could see, the stability in the other business models, which were the way banking is done, granular business and stuff. And so the good news is you're seeing the earnings by the broad industry come out this week. You're seeing things have sort of played out that way, which is very specific business models because of unique circumstances of the last 24 months or 36 months of massive amounts of cash put in the system, and then rates changing caught people, and those had to be sorted out. The good news is the basic industry has reported good earnings across the board. Deposits have come down, but that's intended by the Fed taking money out of the system. It's got to come out of somewhere. Banking system is what they want to do to, frankly, make credit tighter and help slow down the economy. So that's gone on. But you look at the capital, liquidity, and the earnings power of all these companies have been tremendous, and that's reassuring to people, and that's good news because in the end of the day, the banking system reflects the economy in America and economies around the world, and you hope it's in good shape, and it is. There's no question it's good shape.
How'd the regulators do? Were you talking to them through this period of time, and they stepped in, obviously, particularly the deposit insurance, and do you think they should be making changes for the future to make sure we don't go through this again?
I think there'll be a time to look at the deposit insurance scheme in a rational way. It's never the time to look at any of this stuff the day after it happens because people have opinions of what happened. It never turns out to be as true as they thought. And even in the financial crisis, there are a lot of opinions about it started with Lehman. Well, that was the last part of it. It started in 2006 when what happened? Housing prices quit going up. And so, so it took a little more rational thought to think through all the different things that happened. So I think, the debate will be for transactional accounts, should there, during the financial crisis, 2008, 9, I think going on for three or 4 years, there was a guaranteed transaction accounts. So the individual smaller companies didn't have to be cash managed every day and figure out where the money was. And, that's a scheme you could do. There's sort of transactional money in the banking system, there's savings money in the banking system. And the savings money in the banking system is there to get rate and return. The transaction money is there to help the economy going. And the idea is you can ensure that more fully. And that's what they did in the financial crisis to stop people from figuring out. In the end of the day, a scheme like that would have changed the nature of what went on here because people were running around trying to figure out was there $250,000 in one in a small business or an entrepreneurial thing or a big company even. And so I think there'll be time to talk about that. We'll see it play out. It's worked pretty well. I mean, at the end of the day, the industry pays for the deposit premiums. We insure ourselves. The government is the go-between to make sure people believe it's there. And, they get the money back from us. And so this, we just had our earnings and we said our deposit insurance premiums before this went up $100 million per quarter from last year to this year. So I think we're $2 billion a year plus in it. So we insure it. And so this is nice because the banking industry pays for its own errors, and then we have a high instinct to clean it up. And so I think playing with the thought process ought to be carefully dealt with, only because it's been in place since the 30s, and it's worked pretty well.
Your bank and some others stepped in with First Republic to help them out with some deposits, reported by Jamie Dimon. Is that something we should expect in the future? I mean, is First Republic going to need more, or will other banks need more from the other banks?
I don't have any special insight about First Republic. Talking about why we did as an industry, it was to stabilize one of our companies and provide liquidity, because it was a liquidity question. The assets were good. This is kind of the odd thing, because if you're around, any of you are old enough to be around in the late 80s and 90s, that is when the banking crisis spawned. People think the GFC, so-called, was a banking crisis. Actually, the issue was those companies weren't banks. So whether it was all the different companies you heard about that caused trouble, including, they weren't banks, and they were brought in the banking system, put an umbrella around them so they could fix them. In late 80s and early 90s, you had a highly inflationary, high interest rate environment of commercial real estate, and that was a banking crisis, and so that's different, and it happens at a slower pace, and so. We were able to step in and help, because that was an asset quality problem in the 80s and 90s. Commercial real estate, rolling real estate started in Texas, and oil and all this stuff. It just ran through all the regional economies. These companies had great asset quality. It's just they had a liquidity problem, and that's why we put the deposit in, and it worked.
Tell us about deposits, because there's a lot of focus on deposits these days. You have massive deposits, last time I checked, really big ones. As I understand it, your deposit level is down a bit, although it's up from pre-pandemic. What, if anything, have you learned about the stickiness of your deposits from all this? A lot of reporting about that out of Silicon Valley Bank.
Well, there's a lot of reporting about it, but the backdrop is the deposits in the industry pre-pandemic are up 30-ish%. Our deposits are up 34%. It's only 3 years. This is the U.S. We don't grow that fast. So this is, if the nominal economy is up 25 or 30%, not the real economy, but the nominal economy. So what happens is, money got shoved in the system, the nominal inflation came out of it, but that's what grew. So the deposits are up on a rational basis. When the Fed has to, when the system has to unwind, first fiscal stimulus stopped, and now monetary stimulus, the deposits will come down. That's unusual, because deposits in the industry have very rarely ever gone down, but there has never been as much monetary accommodation shoved in the system as fast as happened this time, so they've got to bring it back down. That's what you're seeing. The industry is drifting down. And, we're 1.91 at this quarter, and 1.93 at year-end, 1.93 a quarter, and so it's bumping along at that level, which is $500 billion more than we had during the pre-pandemic. And we think, based on estimates we make, it's performing exactly as we thought, which is, that is really the extra size of the economy reflected through one of the biggest banks in the country and our peers. And so, it'll work its way back down, but it's much slower. It was a quicker pace and slowed down. Where's that money going? Into the money funds. Cash is yielding 5%. That's not exactly economically energizing activity to have people put their money in cash. That's what the Fed's trying to do. It's trying to slow down inflation. Once they break that, the rate structure will come down and the money will move back to do work. And after a period of time, the economy will catch up to the size of it.
Are banks at an inherent disadvantage on their business model? In this sense, you're funding by demand deposits that people, by definition, can pull whenever they want. You're putting into long-term assets, that are long-term, as opposed to some of the private credit outfits who get locked up capital for a long period of time that they can match with the assets. Do you have an inherent mismatch in the deposits versus the assets?
Well, and we manage that. That's why we have outcome management and a team of people, and that's managed to maintain the balance and that sensitivity. So up 100 basis points, we make $3 billion more in NI, and down we make $3 billion less on a base of $55 billion a year. So it's a little bit of movement of money, but that's how you balance it, because the entire balance sheet moves and everybody looks at certain parts of it in this part. So it's the way you manage money. So our consumer customers, I don't know, 80-odd% of the balance have been here, customers for 10 years plus. And even on our commercial side, same thing. All the balance of people have been relationships for a long period of time. These customers have been around for decades, decades and decades in some cases. And so they're very stable. It's just a matter of the ebbs and flows of the rate environment will change the profitability. But you say, is a business model flawed? there's only 4 companies that made more than $15 billion in America in the last 8 years in a row. 2 of them are banks. And so I don't think the business model is flawed.
You reported some nice growth in net interest income in your last report of earnings. At the same time, you mentioned the money markets. You're competing against the people who are paying higher rates. Are you going to have to pay more for those deposits? Is that going to cut into your net II?
It does, except for the assets move too. So so our net interest margin actually grew. Has been growing over the last year in dollar amount and percentage. And the toughest time for us is 0 rates, because we have all these great people, hopefully are clients of our company out there, and thank you if you are. We have your checking account balances, and we can't charge you for those. In other words, we're not going to, in certain economies, they will say, you give us $100 in your checking account, we're going to charge you, we're going to give you less back and negative interest rates, so-called. We don't do that here. So the toughest time for us is when rates are really low, because guess what? The floating rate loans we have are also low. When they expand, they more than covered up. So we went from maybe our NII went up, 25% year over year, first quarter, due to that phenomena. The rate structure went up. The 0 interest deposits are always 0. The other interest deposits go up that we pay interest rates on in the commercial side and the high net worth side and the consumer side. And then what happens is the margin, as a result of those two, and that margin expanded from, I think, 160 to 220 something basis points. So.
What about what you do with those deposits? You said 1.93, is that what you said, trillion, something like that?
1.91, yeah.
1.91 trillion. Do you have ways to make that money work for you? And what I mean by that is, where are you on loan demand? Are people demanding loans? Do they want the money at this point?
Yeah, loan demand is, so now you got to step back and think about what's going on. You have an economy which has a higher than desired inflation rate, and so they've raised rates. So what does that do? That stops loan demand pretty quickly in the mortgage area. So mortgage production, was something $14 billion a quarter, 5 quarters ago, and it's like 4 now. And that shows you the difference in terms of just, it stops it. Cars become more expensive because the payments go up. Therefore, you're seeing car sales slow down. But that's all new activity. The historical balance and stuff, are there. So I think, that's on the corporate side. You have sort of the capital markets oriented companies and the leveraged finance markets that have been kind of screwed up for a while now as rates rise until they settle in, and that goes on. They settled in a little bit in January, February, and then we had the fun in March, and that changed it. So, but overall, loan demand is mitigating. The economy is slowing down. The Fed tightening is having the intended impact. So our loan growth for the quarter was, 4, flattish. It had been growing, 10%, last year during on a given quarter. That is really that loan demand slowing down.
And so where do you put the money to work? Is it a challenge for Bank of America as you have the deposits that are holding up, as you say? You got to do something with those deposits. I mean, at some point, do you put it into Fed excess reserves? Because they pay you a nice amount of money, is the last time I checked.
We put a lot of it there, and that's having the effect that they want to do is that money goes outside the system and basically either holds treasury bonds, either treasury bonds at the money market funds or bills, and then or gets deposited back in the repo program at the Fed. Is kind of so it's taken out of the productive economy, and then the rest of it we invest in non-risk assets, treasuries or mortgage backs, and that's the investment portfolio.
There's been a lot of reporting about the extent to which we have losses on the books. Certainly we had Silicon Valley Bank, but also about Bank of America that haven't been marked to market yet. Where are you with respect to long-term treasuries?
Well, we mark on. This is the AFS portfolio is marked to market. The held to maturity is not. The mark's been going down. We haven't made any investments in held to maturity since the middle of 21. We basically, because we had all this excess cash, we put it to work and we've just been letting it run off, and that's the style we take. So that it's $1 trillion we have to put to work every day that the loan demand doesn't take up. Wow. So it's got to go somewhere. If it goes into no return, then we can't make any money because a deposit doesn't earn you any money, and the activity to support the customer behavior is cost. To let you have access to all those ATMs and phones and digital and mobile and all that stuff. So the way you make money is you put it to work. If you can put it to work on loans, that's always superior. There's only $1 trillion of loans, so all the rest of it has to go into basically short-term and long-term.
Tell us about your trading. You did very well in fixed income, as I recall.
We did. Dimmy and DeMar and the team did a great job. They're up. I think we're one of the few companies that was up year over year in the quarters, and I think second or third highest best they've ever had. And the teams, we invested more in that business. They've done a good job in using the Bloomberg terminal as well. They made some money.
There's a nice plug. Last one on Bank of America specifically, headcount. I think you were actually, you're projecting you're going to be down something like 4,000. Is that attrition or is that a systematic reduction in force?
It really, so, and the colleagues here, I know a lot of tech people, and imagine last year versus this year in terms of, you had to grab any human being that you could hire last year at this time. It was a great resignation. I mean, you're smiling, but it was true. This year, it's completely different. And so our attrition rate has dropped in half. The problem was last year when we had that attrition rate, whether it's Aditya Bhasin in the technology developments or our Tom Scriven in our processing areas, our branch teammates was 50-some thousand people. We were hiring, and we hired 38,000 people last year, 22,000 in the last 6 months of the year. We only grew heads 8,000 people. This year so far, we'll hire. So far, we hired about 5,000 people, and we're net down heads. And the attrition slowed way down. And we'll probably only hire about 10 or 12,000 people this year, and the head count will come down. That's how fast you had to turn the engine on and then turn it off. And when you have half the attrition across 60,000 people from 10 or 11 to 5, 6, think about how much less you have to hire. That's good news for the company because that's a lot of inefficiency to get people up and up to speed. But it was pretty remarkable. So we started at 216 at year-end. We had 3,000 teammates, largely in technology development. We had to come after year-end because we were stepping up our investment from about $800 million a quarter to $800 million a quarter to $900 million a quarter. And so we had to have those teammates to come and do the development work in the first quarter. 3,000 came on, and during the first 3 months of the year, we ended up flat. And by the first 2 weeks of April, we're down to 500 people, and we'll drift down. And it's not, we're not laying people off. It's just the attrition allows you to manage it. But we would deploy people. If you were in this job, we ask you to do that job. If you don't want to do the job that's available in the company, that's a different question. But we're trying to do everything we can because it's the right thing to do for the teammates because we want them to have a career here, which means they'll have different jobs. So this will be a time we'll give them a different experience.
So let's stay on tech since you raised it at this Southside Leaders Forum. Brian, as CEO of Bank of America, what role did tech play actually in the Silicon Valley Bank? Because we've had people like Steve Schwartzman, like Larry Summers said to me, that the ability to just sort of do a bank run on your phone has made a big difference. Did it?
It probably did, but that's not new. We have 60 million consumers. We have 35 million plus mobile active customers. We have 45, 50 million digital customers. It's across all the businesses from mass consumer to affluent consumers. The businesses, they move literally, in the commercial side, digitally, they'll move trillions. You can send $1 billion off your watch. I mean, it's pretty amazing. So that's all a phenomenon that exists. But customers don't independently move money by the device. They move it because of who they are and what they're doing. That's the piece that's lost here. So did it facilitate potentially an easier execution? Yeah, but you could have executed that way a lot of other ways. And that may have had a change of 24 hours or something, but the people would have moved. When you step back, the more interesting question really is how it will be sorted out that way. But we don't see any real difference. We see tremendous digitization of our customer base, but I'm not sure I'd go there as much as I'd think hard about. In the end of the day, everything's gotten easier of life, and this is just one of those trends.
So you've been an early adopter of a lot of technology for Bank of America in various ways. What's the biggest game changer for Bank of America when it comes to technology?
I think it was a smartphone. And so those of you who are aficionados of the history will go back and look, and you'll see when when Apple announced the iPhone, you'll see that one of the few outside apps was a Bank of America app. And because instead of going to, for those of you around that time, the way people did to you, so Verizon, at the time, I'm not sure they were even called Verizon, but they would come and say, we have our cell phone, and we'll embed on it a piece of software, and that can be linked to your banking app. And by luck or smarts, and we can always debate that, but it's good to have a little bit of both in the team, not me. We basically had a web app, a browser-based app in the old language. Well, guess what? We were the only person with it. And if you want to demonstrate this new fantastic product, how do you do it? we took off. We had maybe a couple million people using it, and we just exploded with the smartphone. And then it was how do you make that feature functionality better? And then how do you keep driving it? And how do you keep changing? And so, so that was, but it was the ability to have that, that amount of computational capacity in the pocket, the ability to have it, had the networks, which were pretty bad then and are a lot better now, the ability to react with us, and then the ability to actually fulfill behind it. And so, that was the emphasis, and it's taken off. And so when you speak to Erica, which is a voice-activated artificial intelligence, predictive language engine with a special language built because there wasn't one that existed for financial services 6-7 years ago, and has 18 million people touching it a day. When you talk to it and say, what's my balance? First, I'd understand that you weren't asking about a yoga class, which was part of the challenge, right? Then it has to go find, or what's check number 642 in my account? It has to go find that check. Your 35 million checking customers, all the transactions that were done, and think about that. And by the way, number 642 in my account. It has to go find that check. Your 35 million checking customers, all the transactions that were done, and think about that. And by the way, you could be driving a car at 60 miles an hour, hopefully not driving, but you could be in a car. There's 110 systems behind that mobile system that are feeding it. So it's the combination, the smartphone enabled, that's the breakthrough that just changed everything. You had a computer in your pocket and all these specialists way beyond that. But what really enabled it, as you forget, is the network capacity and delivery. What really enabled it was the ability to pull the stuff out of the systems and the data arrays that we had to have. All that is interesting. Otherwise, you just have a fancy way to get to our website, right? You had to have a way to actually go and find transaction X or transaction Y. Then Erica could lay on top of it. Then, mobile check deposit could lay on top of it. Then, Maggie you could lay on top of it, but you had to have that basic connectivity, and people miss that. So it was the size of networks, the speed of the networks, the pace of networks, the availability of networks, the uptime of the networks, because people didn't want to have it not go through 5 times in a row and be frustrated, because guess what they did when that happened? 1-800 Bank of America. And so, and they call you, and then you have call, so it had to really work, and the team's done a great job from that start till now. But that changed everything, because it democratized computer ownership, computational capacity ownership to everybody, and also made it mobile in a way it wasn't before. Laptops were mobile, but it was a pretty clunky experience. So.
As the head of Bank of America, you have an almost unique insight into the American economy, and specifically the consumer. I know you said that March over March, consumer spending is up. At the same time, you're taking more provisions against possible some losses on some line. What does that tell you about what's around the corner? Are you seeing the end of the spurt in consumer spending?
So three different topics. One is consumer spending in March was up 9% over last March across all the different forms. In April, that slowed down a little bit. We'll see how it ends up, but that slowed down. It was slower in January, February, picked back up in March. That means the consumer's still doing things. They're traveling. It's a lot more travel, out the home experiences, so-called theaters, etc., concert tickets, sporting events. Everything's going strong there. When you look at April, you're seeing it slow down a little bit. The debate's going to be, is that due to some of tax timing and stuff? Because that's changed this year. We'll see it play out. But the consumer's in good shape. They have more money in accounts than they did by the pandemic by multiples, especially with lower stratas. The ones that don't have it are the wealthiest consumers on our platform, because they put the money first in the market, now in the money funds. So they have money. The credit quality, our charge-off rate this quarter was a number which is about a third under where it was in 19, to give you a sense. But that's a 53-year low in 19. So the credit quality is unbelievable. And so that's good news. Are we putting up provisions? Yeah, because we keep planning on this recession. It seems to always be out there that we haven't gotten to yet. But and then the third thing is the consumers have capacity to borrow. So the usage of our lines of credit on the consumer side, home equity loans are down from 30 billion in outstandings to 20 billion outstandings during the pandemic, and the card lines are down from probably 100 and some billion down to about 90 billion. They were down as low as 70 and come back up. So there's plenty of borrowing capacity for consumers. So that means the consumer is going to be there and they're employed, which means the job of the Fed is tougher. And that's why the Fed has to be more resilient, because the consumer drives the U.S. economy, and the consumer is still in the game, and the consumer is still employed, and we're paying our colleagues and teammates more than everybody in the room, and then they have money in accounts and they're spending. And that's not true for every single human being in America, but it's the average is true that way.
One last question, Brian. You are the chair and CEO of Bank of America. You've gone through a lot of experiences to get there, developed a lot of experience as well as expertise. What has helped you the most? And will the next generation CEO of Bank of America draw from the same skills, or will it be different? Are we going to have an engineer? Are we going to have a data scientist?
Well, I think, I'm not sure. At the end of the day, you got to be curious, and I think, you know, whether it's myself, I tell myself that, or whether I tell the teammates that when they ask me the question about what, and you just have to keep assuming you don't know anything, and ask questions and get smart people, and then be able to judge what they're telling you, and figure out how to do it. And that will be the trait. That type of trait will be the trait, because if you don't run the company. We have 200,000 plus teammates. They run the company. The 20 management team members run the company. You know, but you have to be curious. You have to think about what's going on. You have to try to learn. You have to learn from other people. You have to learn how to absorb different types of inputs. There was a point in time way back in my career when I almost became the head of technology, for example, and I had no skills to do it. But what I could do is, the people told me at the time they wanted me to do it, and I told them there's probably a better idea here. But it was because they said, well, you can get people to work together and think, and that's what the traits I think of a good leader in a company have. So you got to be curious, you got to keep learning. But I'm not sure the next CEO of Bank of America has to be an engineer, has to be a data scientist, has to be a trader, has to be a consumer banker, has to be a commercial banker, has to be an investment bank. It can be any of those things, but they always realize no matter where they came from, they got to have an ability to absorb and learn a lot of other things, and that's by asking questions.
Brian, thank you so very much. Ladies and gentlemen, Brian Moynihan. He's chair and CEO of Bank of America. Thank you.
All right, everybody. You are listening and watching Bloomberg Business Week on Bloomberg Radio. You have been, though, listening to our own David Weston. They're talking with the CEO of Bank of America, Brian Moynihan, and an interesting conversation, so relevant, if you will, considering everything that's been going on and some concerns about the banking sector. That was David and Brian here at Bloomberg headquarters at the Bloomberg Sell-Side Forum. And a very good afternoon, everybody. It is Thursday, April 20th, 2023. I'm Carol Master, along with Bloomberg Quick Take correspondent Madison Mills. And, Maddie, just some of the headlines coming out of Brian, talking about that they're planning to hire this year some 10 to 12,000, or this year, I guess they're gonna hire a bunch of workers, but their headcount has been somewhat down.
Yeah, he said no layoffs, though, very clearly there on the screen. And he also echoed what so many of our guests have been saying, that crisis is too strong of a term, and maybe even that crunch is too strong of a term. That's what some of the guests on surveillance were saying earlier today, that it's more of a contraction than even a crunch.
The fine nuances of the English language. Brian Moynihan of Bank of America also saying there are signs the economy is slowing and that loan demand is mitigating. This is going to be a nice backdrop for upcoming economic and market conversation right here on Bloomberg. All right, everybody, you are listening and watching Bloomberg Business Week live in our Bloomberg Interactive Broker studio. We're streaming on Bloomberg Originals and on YouTube. We've got a market where stocks are down, bonds are up after some data signaling that maybe we are seeing some softness continuing in the U.S. economy. So we're going to talk about that. We're also going to talk about the results from the world's largest owner of commercial real estate, what they reveal. This is a big one.
This is a big one. It's also a big day for Elon Musk. It's his favorite day, 420. So we've got a double dose of Elon Musk news for you. Not just Tesla, we've also got SpaceX, the Starship rocket exploding this morning. So that's big news we got to talk about.
Absolutely. I think we were all over it this morning. Goodbye, exciting and volatile meme stocks. Hello, boring old bank savings accounts. You can actually make 4 or 5% on a boring old savings account. So it's making a shift there, certainly in the banking sector.
And good advice for consumers listening in, too. We're also going to get a window into the U.S. mortgage business with the founder and CEO of the fintech software and platform company that works with 15 of the top 25 banks and lenders in the U.S.
All right. So interesting interesting perspective. And then we've got a husband and wife team on Second Acts. They run businesses, so they've got this interesting perspective on life changes, but also on what's going on when it comes to being a small business owner. All right, we do want to get, though, to the market and the economy. We mentioned some of the comments that the CEO of Bank of America said that there are signs that the economy is slowing, and we got that in some data points today, including weekly jobless jumping to the highest since November of 2021. We got a gauge of manufacturing activity in Philadelphia plunging in April to the lowest since May of 2020, and U.S. home resales resuming a slide. So let's make sense of it, our roundtable on it all and some of the market reaction. With us is Bloomberg News International Economics and Policy Correspondent Mike McKee. He's here in our Interactive Broker studio. So let's kick it off. Mike, fair to say the economy is slowing? Brian Moynihan has it right?
There's no question the economy is showing signs of slowing. The first quarter GDP numbers, which we're expecting next week, are likely to be fairly strong, roughly 2.5% according to the Atlanta Fed GDP now. Now, that's rearview mirror stuff, but it is more than people anticipated. The economy has held in a lot better than people anticipated. But yes, we are seeing some slowing. Demand for goods is down, so manufacturing is down. You got that in the Philly Fed survey today. But at the same time, we're also seeing prices go down. The beige book that came out yesterday suggested that price increases have started to moderate. The Philadelphia Fed number today for prices paid, if you leave out the crash right after the pandemic, it was the lowest since 2016.
Wow.
So prices are starting to fall. The question is, how fast do they fall? And then how far does the economy go? Has the Fed gone too far in tightening credit? I do laugh at people who talk about credit crunches and things like that. It's like they predict in their newsletters and on radio and television that the economy is going to slow down, and then all of a sudden it's, oh my goodness, the economy is slowing down. It's what we were expecting to happen.
It does sort of feel like that, right? Like we're all of a sudden in this slowdown that we've been predicting and talking about happening for months. I wonder if you're seeing signs of that in the labor market too, Mike. Can we call it cracks in the labor market yet?
I don't think so. I think we should be seeing it, and it should start to come up soon, but it hasn't really. We were talking this morning about jobless claims. Yeah. Steve Stanley from Santander is our expert on the fact that every so often New York City public schools or New York State public schools have a week off, and then everybody who works for those schools under the law in New York can file for unemployment. So we went up 5,000 in the latest week, and he said that was because everybody was off school, and that next week that should go back down again. So we're really not seeing any signs of all these massive layoffs. There's some reasons for that, maybe because if you get severance, you're not eligible while you're getting severance to get jobless benefits. People may be finding jobs quickly. And so we don't know what's actually going on out there. We anticipate that unemployment should go up, but it's really not happening yet.
Yeah, I think this is what's wild. I mean, I think we've talked about this before. I mean, we're seeing a slowdown, right, in economic activity. Is it a case that we should assume that we're going to hit a recession because that's what happens in cycles, or not necessarily?
Well, that's a real divide in economics because there's a camp that is very strongly believing that the Fed tightens, credit tightens, people stop spending, unemployment starts to rise, it feeds on itself, and you have a recession, and so we are going to get a recession. And they have a whole bunch of statistics they can show you that suggest that's going to happen. And then there are other people who say, no, the economy has been stronger than we anticipated. Companies are holding on to workers because they had such a hard time getting them after the pandemic. And so we aren't going to see the same cycle. And really, we're not going to know for a year whether that happens or not. The predictions are we're going to see a slowdown in the second half of the year, so maybe you start looking at it then. But at the same time, predictions are in the second half of the year, inflation's going to come down much faster. So then maybe the Fed doesn't have to be as tight. This is really an unusual time.
Can I ask you what you think the constructive conversation is to have around the economy? Because I do feel like, we hear like, okay, here's what we think the Fed's going to do. We think we're going to go to a recession. Maybe it'll be like, it just feels like it goes back and forth. So what do you think is the smart conversation or constructive conversation?
Well, I think the biggest thing now is what are people seeing in terms of lending? And that would be like a question for banks and or bank analysts. And the other aspect of it is if banks are not making as many loans as they did, is that because they don't want to, because credit standards have gone up? Or is it because people don't want to borrow because they did borrow a lot when interest rates were low, or because they see the economy slowing down and they don't feel the need to invest. So there's, it's really, that's kind of the crux of the question right now about what's going to happen, and then whether or not you are, as a businessman, taking steps to prepare. In other words, are you going to be laying off people, or as Brian Moynihan says, we're not laying anybody off, we're going to hire people, but we're letting people go through attrition? That seems to be kind of the preferred way of thinking about it right now.
Can I ask you about this? Because I keep hearing economists on our shows say, you know, the impact, it's only going to be small businesses, as if that's not a big deal. But isn't that kind of the bread and butter of the American economy? Small businesses, consumers making up a huge part of our GDP. So at what point do we say that credit crunch impacting small businesses, that is going to be the thing that pushes our economy into a recession?
Again, I hate to keep saying it's hard to tell, but it's hard to tell. And the reason being is that many small businesses, yes, are funded by lending that standards could get tighter. But a lot of people, what they do is they're using their credit cards to finance their small business.
Isn't
and
that bad?
Their credit card interest rates are going up, but they're not taking away their credit cards. And they just keep paying. They pay their credit down as they get their revenue. So it may not have as immediate effect. What you might see is the people who go to a bank and say, I want to start a pizza place, they might find it a little harder to get credit, and that pizza place won't get built. But remember, we've lost so many small businesses because of the pandemic. And even if you opened your pizza place, where are you going to find the workers? So that's an issue as well.
All right, so let's bring in and get to the market side of this great economic backdrop in terms of today's trade and today's environment. So Abigail Doolittle is with us. She watches the market. She's markets reporter here at Bloomberg News. Mike, going over the day's economic news, but also kind of the broader backdrop, as I said, Abigail. How much of that is reflected in the market? How much of that is maybe earnings, or a little bit of both?
I'm not actually sure what's going on today because we've had some pretty wobbly trading. At this point, we're looking at stocks close to session lows, down about 0.75% for that S&P 500, down 1.5% for the New York Bank Index. And then you have the banks, the KBW Bank Index down 1.7%. Earlier, though, the S&P 500 almost flipped higher, and it felt like we were going to see that. But we've had a pretty steady decline from about noon on. It's actually the largest decline, if you can believe it, in about a month, and that's because we've been looking at this slow melt-up. You know, the markets recently, it's just felt like there's not much to write home about. It's sort of just
such a tight range, right, for a while?
It's a tight range, but it's also a range that's going higher. Now, technically, the S&P 500 is starting to break out to the upside, so if we were going to bring the economic picture into that, it would suggest that stock investors right now do not believe that a recession is ahead, this recession that everybody is waiting for. Or another way to look at it is you could make the case the recession did already happen from the standpoint that technically we did see 2 quarters of GDP falling, or maybe it's much further out. You know, there's this big talk between bonds and stocks. Are bonds right or stocks right? I'm going with the stocks, even though from a traditional standpoint, the bond investors are smarter.
It is a really funny time. And
Lock the doors now.
Well, the bond people will tell you that's right. But I mean, you have these weird things starting to happen in the markets because of the debt ceiling too. Your 1 month T-bill is yielding about 200 basis points lower than your 3 month because people don't want the 3 month because it falls into the red zone when the government could default. So you're starting to see some reaction in the bond market to the debt ceiling. But otherwise, the bond market has been like a roller coaster up and down.
Yeah, the bond investors, I mean, the reason that I believe stocks right now, if you take a look at the last year, year and a half, I feel like the stock investors have been more right than the bond investors because the bond investors are getting whipped around by the Fed. I mean, if they simply listened to the Fed and believed the Fed, bond yields would have simply basically gone higher and stay there. Instead, it's the roller coaster that Mike is talking about. But I think something to think about with these traders, and I believe we've talked about this before, is a lot of these bond traders, they've never traded without the Fed there. So for them to believe that the Fed's going away, they have a really hard time believing it. Plus, you have the 210s inverted. So, of course, that does suggest that a recession would be ahead. So I think they've been planning for that. But I think the stock investors, I think that the pain was last year.
So, Mike, what? Go ahead.
No, I was just laughing.
Well, no.
Pain is always in the market.
So, okay, Fed speakers, we can hear up until what, the end of tomorrow, and then they go into the blackout. So if it does feel like there's a calmness, certainly within the banking community at this point, that maybe it was just a crisis of a few banks rather than a bank crisis. So having said that, how should we anticipate potentially the Fed policy will ultimately come out in that May meeting?
Oh, in the May meeting, I think there's no question they'll go another 25 basis points unless something weird happens between now and then, because they've pretty much all said that. And
there's no data up to that point that could sway them?
Not that would really sway them. I mean, we've talked about GDP, but they've done those calculations. And then we'll see what happens with the PCE inflation number, but they can do those calculations too. So I think they pretty much know what the economy is going to be like roughly on May 3rd. And so they will do what they said they were going to do. And enough of them have said basically then we should be prudent, look around, pause, see what happens, because we have a lot of tightening that's still in train, still to hit the economy. So let's see what happens with that. Let's see what happens with the debt ceiling. I'll bet you in the minutes that we get from this coming meeting, they're going to have a section about talking about what to do, because it may be moving up, and so
it's like amazing that we're having this all over
again. It's going to be.
Can we talk about that, Mike? Because your sources talked to you about the tax bill specifically, right? And we didn't get the number that people were looking for.
No, well, analysts were basically saying that if Treasury got over $200 billion in taxes, that would be good, because they set an X date of roughly the 5th of June, and the 15th of June is another tax day, because it's quarterly tax payments that are due from people who are self-employed. And so they would get another tranche of money then, and that could push X date farther out. But they thought if they got $200 billion, that would get them to that 15th. If they got below $150 billion, then that raised questions, and they only got 108. So it raises questions about whether we can make it to June 5th. It's very hard to tell, because you don't know on a day-to-day basis how much the government is going to have to spend, what bills come in. But it does look like it's going to be an earlier crisis or thing to worry about.
Yeah, like I'm stressed.
You don't have to pay for it. Well, oh, yes, we do, because it's actually taxpayer money.
Yeah.
Well,
or somehow. It gets worked into
somehow,
it.
well, you look at the scenarios that economists have modeled, and there's everything from nobody really notices to Armageddon, the world comes to an end, depending on how this plays out. So
it's just another thing that investors have to kind of keep on their radar.
When you're throwing hand grenades around, you never know.
It's unbelievable. Tesla, was that a big deal today?
I'm so glad that you just brought that up, Carol, because if I had one moment to talk, that's what I would have talked about. And I think that instead of saying that it's not clear exactly what's going on from the market, at least macro-wise it's not, Tesla is probably the biggest influence. And I was just taking a look at it. It's at session lows, down 11%, close to its lowest day, close to being down more than it had been in January, which was when it was really plunging. And, it's interesting that investors are so disappointed by this, because they did put up record deliveries. We knew about that a few weeks ago, 424 or something. They're saying that they're on track to do 1.8 million cars delivered, but it's all about those margins coming in on price decreases. So there's some pain right now as they try to change their business model. Like before, because they were the only car out there that you could get from an electric standpoint, they could do whatever they wanted. But now that there's competition, and with the economy being maybe a little bit softer, maybe, I'm not sure about that, they have these price cuts that are weighing on margins in about 200 basis points. And I think a lot of analysts are thinking that that's going to be a continued trend. Will the stock crater back to this year's lows? Probably not. I don't want to say it was priced to perfection, but it was almost a double off of those lows. So
yeah, there's been some thinkings about the valuation here with the continuation potentially of price cuts and what that means and whether or not it's getting overvalued. Hey, Mike, one last thing. Next focal point for you.
Well, next week we'll be looking at both. The Thursday we'll get the GDP numbers, and Friday we'll get the income spending and PCE numbers. Those will be the next focal point. But after that, it's Jobs Day the following week, and the Fed. So we've got a big week ahead there. I just want to mention in terms of Tesla, Elon Musk.
Yeah.
My blue check went away today.
Did it really?
No.
That is redhead.
Oh my gosh, I have to check mine.
Yes, check your.
To our favorite.
Is yours gone?
Mine. mine.
Oh my
Everybody's blue
gosh.
checks. Yeah, they said they were taking rid of it
And so what does
today.
that mean? You have to pay for it now to get it back?
If you want it, you have to pay for it. But the whole point was
To, like,
that
just-
if you had a blue check, they had verified it was you and it's not an imposter account.
'Cause I
now,
had it.
now anybody can.
I had an imposter account, and years ago. So,
All right, y'all.
thank you, Elon. Happy 420.
More than one thing blew up today.
Thank you so much.
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 3:21 on Wall Street. We do check markets all day long. We have got the Dow, the S&P, NASDAQ all declining. Right now, the S&P very close to session lows. 38 minutes to go ahead of the closing bell. The S&P right now down 36, drop there of 0.9%. The Dow down 197, a decline of 0.6%. NASDAQ is down 129, a drop right now of 1.1%. 10-year yield at 3.54%, with the 2-year 4.16%. Spot Spot gold at $2,004 the ounce, up by about 0.5%. West Texas Intermediate crude down 2.4% right now, $77.29 a barrel. Truist Financial, Fifth Third Bancorp reported deposits that were broadly stable in the first quarter as banks weathered the fallout from the collapse of 3 lenders in March. Mona Mahajan is senior investment strategist at Edward Jones, and she was interviewed this morning on Bloomberg Surveillance.
Yes, there has been a little bit of deposit flight, especially from the regionals to the larger banks. But in fact, both large and regional banks have reiterated the message that, one, the consumer is pretty healthy. 2, there is no systemic risk really to the system that's imminent. And from a Fed perspective, really that probably does help them reiterate the message we've been hearing all this week, that they need to continue on this inflation battle.
And we do have shares of Truist Financial down 3.2%. As for Fifth Third Bancorp, down 2.2%, down 0.2%, and Comerica shares down 2.1%. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
All right, Charlie, thank you so much. Carol Master, along with Madison Mills, live in our Bloomberg Interactive Brokers studio, streaming on YouTube and streaming on Bloomberg Originals. Did I say that twice? My brain's a little...
No, you nailed it. Yeah. Bloomberg Originals.
I think I need a cup of coffee. Shares of Blackstone, we're keeping an eye on them today because we've seen them actually kind of bounce around a little bit. Down about almost 1.9% at its lows, up about 2.6% at its highs. Right now, just down about 0.7%. This after first quarter profit fell as the deal making at the world's largest alternative asset manager slowed in a tumultuous stretch when rising interest rates roiled the markets and banking system. While assets under management failed to surpass that $1 trillion mark we've all been kind of focused on, that and analysts predicted it would happen, they still rose 8% to over $991 billion. So our Bloomberg surveillance team actually caught up with John Gray, president of Blackstone Group, along with Bloomberg Wall Street reporter Sonali Basak. They talked about the quarter. Most importantly, though, they also talked about the firm's commercial real estate exposure.
There's no question that credit will be tighter to commercial real estate. Some of the good news is the agencies, the government agencies, Fannie and Freddie, lead the way in multifamily lending and apartment lending. There is strength in other areas. Real estate lending is broader than just banks because insurance companies, commercial mortgage-backed securities exist. Mortgage REITs are out there. So there are multiple sources of capital, but I do think credit will be tighter in commercial real estate. The one benefit to existing owners is construction lending is going to get a lot tighter, and so you'll see less new supply. Long term, that's a positive. But yes, I think we will see less capital available. It will dampen things a bit. But ultimately, fundamentals around supply and demand are what drives value. And that's why I have confidence going forward in most of the sectors, certainly away from office buildings.
Blackstone had been in talks with Valley to buy some assets from Silicon Valley Bank. I'm really curious what this says about your ambition in this banking kind of tumult period. Do you think you could do more by means of working with regional banks, providing more credit where credit is tightening up, especially given some of your private credit books are up more than 9% so far?
I think that's a great question, Shanali. Interestingly, of the $40 billion we raised in the quarter, 60% of it came in our credit, insurance, and real estate credit areas. Investors are allocating more capital. We have in total in those areas $350 billion. And so I think there's a real opportunity. We're actually in discussions today with a number of regional banks to partner with them. They have very valuable relationships with borrowers out there across the country. We have long-term capital, and so in consumer financing, in small and medium business financing, particularly in the asset-backed area, we think there's a real opportunity to deploy more capital. And I think it's one of the real strengths of the alternatives business. As you know, this used to just be about private equity, real estate private equity. But what we do today is much broader. And I think the private credit area is really at a golden moment because we do see tightening out there, and yet we have this large pool of capital to deploy. And so I think you'll see us become much more active.
All right, that, of course, was Blackstone Group President Jonathan Gray earlier on Bloomberg. Massive in private equity, private credit, real estate. So let's get more into the company's results in color and what it kind of says to us about the business environment, the market environment, provided by John Gray. So let's get into it with Bloomberg Intelligence Global Banks analyst Paul Goldberg. He joins us via Zoom in New Jersey. Paul, nice to have you here with Maddie and myself. So the quarter, what it says about the company and the overall broader market environment, what's important in terms of what you heard from Blackstone today?
Hi, Carol, and thank you for having me. I think the results were largely consistent with what the street was expecting. So you had a decent private equity results, even though the fundraising is experiencing some delays. You had a very healthy credit results, and you had some pain in the real estate segment, predominantly in realizations and performance fees, which is obviously there's not much to sell in this market.
Yeah, that's definitely interesting to think about.
Well, and Paul, I do wonder, if you think about Blackstone, they're the world's largest owner of commercial property, right? And its real estate was the biggest source of net inflows in the quarter. Dig a little bit deeper for me, if you would, in terms of the real estate exposure, because I do feel like that is, as we look at the banking sector, and we're all kind of sighing, some relief here because of what we got from the big banks and some of the big players in the regionals. We're wondering, though, okay, what's next? Is it commercial real estate? Dig a little deeper, if you would, in that area.
Yeah, I mean, in terms of real estate, Blackstone is the largest among the 7-8 larger peers in terms of the real estate as a percentage of total assets. It's about a third of them. But the commercial real estate, as all the commercial real estate experts would say, it's a collection of about 15 different segments, right? Mm-hmm. So the office area is the area where you get in some pain and where people are seeing the most risk. But then there are areas where Blackstone has the largest exposure, dominant exposure. It's about 90% of their real estate exposure. So we're talking about multifamily. We're talking about logistics assets. They invested in some healthcare-related properties that develop products and so on. So in terms of the office, it's about 2% of the real estate portfolio, which works out to be about 1%, less than 1% of their overall total $1 trillion that you mentioned before.
Yeah, so minimal, right. We are all worried about, as people are working from home, what's happens to office real estate. So, right, so yay for them on their limited exposure to office. But when it comes to homes, whether it's multifamily or other, if there is some concerns about a downturn or a recession, if we start to see unemployment tick up, how vulnerable are they?
I mean, they are. Obviously, you have interest rates going up, so this is not good for the business. But if you think of multifamily properties and they're long tails where they don't have to sell them, as long as they're able to maintain the financing on them, and as long as they're not forced in any situation to sell those, rents actually often do really well in a recessionary environment because people can't buy properties. They can't get the loans, so they rent. So the rent kind of trajectories have been doing fairly well.
Earlier today, the COO said that the logistics space is looking good for them. Are you also seeing that in your research?
Yeah, generally, logistics has been a strong suit for everybody. I mean, but I'm guessing last year you've seen Amazon giving back some of the warehouses, for example, as they apparently build out too much capacity during the pandemic. But in general, everybody still get their Amazon package in front of the door every day. So there is a lot of activity there.
So let me just ask you, Paul, so when you look at their revenue breakdown, and we know that their private equity, their credit, their insurance, their other real estate related is the bulk in terms of revenue. We know that when it comes to Blackstone, even though John Gray kind of was talking about how much more they are and maybe where the growth is, but real estate's a big deal. We look at Blackstone as someone who is a great indicator of what's going on in commercial real estate. So what can we glean from them more broadly? Can we say that, okay, Blackstone's okay, but there are still questions out there in commercial real estate? Or can we say, if Blackstone is saying this, we should all calm down a little bit? What's our net takeaway here?
Well, I think Blackstone is saying it from their perspective of the small exposure to the risky sectors of the commercial real estate, right? So if you turn around and look at the banks and the insurance companies that John Gray mentioned, that office exposure could be somewhat larger there, and that becomes more concerning.
All right, we'll certainly keep on our radar. Paul, thank you so much. Appreciate checking in with you. Paul Goldberg, he's Global Banks Analyst at Bloomberg Intelligence via Zoom in New Jersey. And I'm just looking at shares of Blackstone. I said all over the map, but it's been kind of a funky little day here generally for the market. 2.5% higher at its highs today, 1.9 at its lows. Right now down about 0.8%, but massive company, as we know. And, you know, Maddie, it's up almost 24% year to date here. And we're talking about a company with a $108 billion market cap, but we were kind of waiting to see if they hit that $1 trillion in assets. Yeah. Close, but not quite.
Yeah, and you're so right. It's the gains and the losses all day. It feels like the market is still kind of deciding whether or not Blackstone's diversification is good enough for them.
Yeah, in general, the market environment, right? Like we're just trying to figure out, okay, what's next, what next? It's just really kind of tricky. All right, you're listening and watching Bloomberg Business Week. Let's get a check on world and national news. For that, off to D.C., our 99.1 newsroom, and Nancy Lyons. Hey, Nance.
Thanks, Carol. President Biden is expected to sign an executive order in the coming weeks that would limit investment by U.S. companies in key parts of China's economy. Treasury Secretary Janet Yellen today said any action would be aimed at protecting national security, not punishing China. The administration has been debating the measure for almost 2 years. Well, President Biden is edging closer to re-election, even if he isn't saying so.
Sources tell Bloomberg News aides to the president have started interviewing potential campaign managers, and they've been talking about when and how to kick off a 2024 run. Last week, President Biden told reporters in Ireland he'd make his announcement relatively soon. In the meantime, he has been holding campaign-style events, including yesterday's speech on the debt ceiling in Maryland. Allies say Biden can hold off on making his announcement because he has the bully pulpit of the presidency to spread his message. In Washington, I'm Nathan Hager, Bloomberg Radio.
The Senate Judiciary Committee Chairman, Senator Dick Durbin, says he's invited Chief Justice John Roberts to testify before the panel May 2nd concerning potential ethics reforms for the highest court. Durbin says Roberts' last significant discussion on the ethics at the committee was back in 2011. Any testimony is likely to center on business transaction and travel by Justice Clarence Thomas. SpaceX is regrouping following today's explosion of its Starship system just minutes after takeoff. Here's Bloomberg's Ed Ludlow.
We were tracking at the 3-minute mark for the Starship spacecraft to separate from the Super Heavy booster. That did not happen. Basically, the full stack remained connected, and once it reached a certain height, the combined Super Heavy booster and Starship spacecraft started falling back down to Earth.
Again, that's Bloomberg's Ed Ludlow. Global news 24 hours a day, powered by more than 2,700 journalists and analysts in over 120 countries. I'm Nancy Lyons.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 3:40 on Wall Street. We do check markets all day long here at Bloomberg. Do want to begin with a developing story, though. A headline on the Bloomberg Professional Service. Alec Baldwin's lawyer says charges have been dropped in the Rust shooting case. We've got stocks lower across the board. Let's head right over to the First Word breaking news desk for today's afternoon call. Here he is, Bill Maloney.
And good afternoon, Charlie. That's right. U.S. stocks under pressure right now. The Dow currently down 176 points. S&P's dropped 34, and NASDAQ is lower by 1%. The U.S. 10-year yield at 3.54%. Gold is up 10. Oil trading in the red. And Bitcoin is down by 3.6%. Of the main 11 S&P sectors, all were in the red, led by losses in consumer discretionary, energy, and real estate. And leaders to the upside in the Dow, Walgreens, Visa, and Walmart, while Verizon fell 4% and led to the downside. After earnings, AT&T fell 11%, Tesla dropped 10%, and Seagate was down by 9%. In other news, Bank of America's Moynihan says there are signs the economy is slowing. And wrapping things up, Rail CSX reports after the bell. Live from the First Breaking News Desk, I'm Bill Maloney. Charlie?
Okay, we thank you very much, Bill Maloney. And to hear live breaking news on your Bloomberg, type Squawk, S-Q-U-A, on your Bloomberg terminal. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
I'm driving in my car. I turn on the radio.
How about you let me drive?
Oh, no.
Who's gonna drive you home?
Honey, please, I'll do the driving.
Drive on.
Excuse me, I want to drive.
It's
the question that drives us.
This is the Drive to the Close
That funky music will drive us till the dawn.
on Bloomberg Radio.
Gotta say, it feels like we're watching the markets a little bit in slow motion today.
Right? Like, what is happening?
I don't know. It's really kind of a weird, maybe it's just that marking time until we get the next Fed decision. Curious what our next guest has to say. We are, folks, just about 17 minutes away from the closing bell. Stocks just off their lows of the session, as you heard from Charlie. But tech, really thanks to Tesla probably taking the biggest hit. Time for the drive to the close. Marianne Bartels is back with us, Chief Investment Strategist and Managing Director at Sanctuary Wealth, a financial platform for investment advisors. She joins us once again on Zoom in Nyack, New York. Marianne, good to have you back with us. It is an interesting market environment, and we've seen some tight ranges, certainly on the equity side of things. What to you seems to kind of have it right? Is it what the equity market is maybe showing, some debate about what comes next, or the Treasury trade? I'm curious how you see it.
Thank you so much for having me back, Carol. Yes, you're absolutely correct. The market has really been range bound, and those are frustrating markets because it really doesn't feel like a trend. Although technically we're slightly in an upward bias. So the range has been 4,200 on the high end. We haven't been able to break above that, and I would say there's good support around 3,800. I would say very short term, the technical indicators are saying that we can get a pullback here, and you're seeing that happen today. But when we look at the technical indicators longer term, meaning more monthly type of price momentum indicators, we're actually getting buy signals. So we think these pullbacks are a great opportunity to buy. And what's really probably allowing the market to have a bias to the upside, and why with all what seem to be the negatives, like corporate profits peaking, margins peaking, interest rates up really high, risk of a recession, although we've been talking about that a long time, is it seems that investors are positioned for that. Very defensive, a lot of cash on the sidelines. And when we look at fast money or, traders like hedge funds, they're positioned very short the market. They're already short. So I think we have a floor here on the market. And I think that over time, we're going to have a bias to the upside, but you're going to have to break above that 4,200 to get all this negative positioning in a more positive light.
So, Marianne, when you say technical indicators longer term on a monthly basis, signals to buy, is it some of the things you just talked about in terms of traders short the market, cash on the sidelines? I'm curious the specifics of what you're seeing technically.
Yeah, so if you use one of my favorite indicators is called the stochastic. And we did a 14-month stochastic. We've actually been watching it since December, expecting a buy signal this year. And sure enough, we've gotten a buy signal. Now, there's been other indicators that are not as well known. One is called COPIC. And again, that's a price momentum type of indicator. And one was developed by Marty Zweig. He was very famous for calling the crash in 1987. Unfortunately, he's not with us anymore. But he developed this indicator that's called the Zweig breath, or the Zweig thrust breath indicator. And that's based on being very oversold and in a short period of time getting very overbought. And we don't get these signals very often. Now, they're kind of mixed on their tactical reading, but in the last 6 readings that we've had from the indicator, the market was higher 12 months later. So we really are starting to see some of the indicators go very bullish the market, although they're not getting a lot of press.
Do you think that earnings are going to support that idea moving forward?
So that's the problem. We don't have the earnings, or at least we feel that we're in a corporate profits recession. But again, as I said, everyone's positioned that way. And markets get locked, and especially have a floor to the downside when you have positioning so bearish. So what I think has to happen is you have to flush out the market. The only way you're going to do that is by going up, forcing everybody in, and then resetting the market, and then we'll see where we go. That's what I think is the risk to the market. I think the risk is to the upside.
That's interesting. What do you make of the VIX? Do you care about it? The volatility index, it's now it's a little bit above 17, but it had been moving down pretty substantially.
It has, and it kind of technically broke down. Now, I've heard some derivatives traders say that the VIX, the way it's calculated and how it's being used in trading, is not as informative. But I still like to look at it. And it's technically broken down, and it's actually signaling the opposite of what the market is doing. You would think with the VIX going down, the market would be going up, and the opposite is actually happening. It is maybe possible that the VIX continues to go down, and we're in this trading range type of environment. But I would say that there's some confusion in the behavior of the VIX.
Yeah, that's confusing to me that they're like dislocating, and I don't know what to make of that, but I also don't know what to make of a lot of the dislocation that we're seeing in the market right now. Really quickly, I want to ask you about something our markets reporter told us earlier, saying that markets may have already priced in that we're past a recession, that it already happened and we're breaking out to the upside. Do you agree with that?
I don't think we've priced in a recession, although I think positioning has priced in a recession.
Okay.
So that's different. I don't think the market has, but I think investors have priced that in.
All right. What about on a technical basis? One more question, Marianne, is there, when you look at the technicals of various sectors within the broader market, is there any that are saying, here's a really good opportunity, really signaling a buy?
So there's a lot of different ways to look at technicals, Carol.
Yeah.
I've been very bullish semiconductors. I still have a cyclical bias. I still like aerospace and defense, but I want to balance that out with more defensive sectors like healthcare and utilities. So I think in a trading range market, you want a little bit of both.
All right, that makes sense. Hey, so great to check in with you. Have a great weekend. Marianne Bartel, she's Chief Investment Strategist, Managing Director over at Sanctuary Wealth, joining us via Zoom from Nyack, New York. And this on a day where you do have stocks down about 1% on the NASDAQ, and a lot of that is about, I think the NASDAQ 100, about 3%. Tesla makes up that index, so that's definitely a drag. Down 0.8% on the S&P, and the Dow just down about 0.6%.
Yeah, and the one thing that I didn't have time to ask her about that I'm curious your thoughts on, Carol, is the fixed income play. Like, are we moving into a year of bonds being the winner here?
I don't know. Everything got killed last year. If we start to see the Fed move around and we start to see rates, moving lower, then we certainly could see some better, bond market situation. But we'll see. I mean, right now you've got a 2-year note. It is down below 4.2, down at 4.15, so just below it. This is Bloomberg.
Your company news headlines on Bloomberg Radio.
From Bloomberg World Headquarters, I'm Charlie Pellet. 3:53 right now on Wall Street. Bank of America CEO Brian Moynihan says the recent turmoil that hit regional banks in the U.S. did not rise to the level of crisis.
Well, I think at the end of the day, crisis is too strong a word, and words like that get used a lot. But at the end of the day, there was a fair amount of disruption for a few weeks there. Well, certain business models were sorted through, but on the other hand, you could see, and we could see, the stability in the other business models.
And interviewed here at Bloomberg World Headquarters, Moynihan said the deposit insurance covered by lenders did a good job of protecting customers. Elon Musk is indicating Tesla will keep cutting prices to stoke demand, even after markdowns early this year took a significant toll on profitability. And today, a significant toll on the stock. We do have shares of Tesla moving lower by 10%. Dan Ives is with Wedbush Securities.
For many, many years, Musk has played chess, others have played checkers. But now, in terms of competition growing, in terms of what we see 313 area code for GM, as well as out of Europe, Now this is a time to gain market share, but at what price? And that's why I tell you, most investors, the frustration is sort of that margin story. Does it get into that mid-teens?
And again, Tesla down 9.8%. IBM higher after earnings. It gave a forecast for annual revenue that was in line with analyst projections. IBM shares, they're up now by 3 cents. Little change. Those are some of the stories that we're following at this hour. I'm Charlie Pellett. This is Bloomberg.
You're listening to Bloomberg Business Week with Carol Messer and Tim Stenovec on Bloomberg Radio.
All right, everybody, you are listening and watching Bloomberg Business Week on Bloomberg Radio, live in our Bloomberg Interactive Broker studio. We are on YouTube. We are on Bloomberg Originals. Carol Messer, Maddie Mills, and just a few minutes left in today's trading session. Having said that, one of the names definitely on our radar. It's a great indicator of what's going on in the financial sector, consumer sector. We are talking about American Express and the stock. Charlie's certainly been talking about it. Down about 0.8%, but Maddie, at its lows today, was down 6.6%. So down, but not as negative as it was earlier on.
Yeah, pairing some of those losses, maybe some forgiveness in the market there, but it was one of the worst performers earlier today in the Dow Jones. Provisions for loan losses at Amex topped $1.1 billion, which was well over what those analysts were expecting, and shares were up 11% yesterday, so getting a little bit of punishment today as well. They were actually beating the S&P yesterday, so now coming down from those rosier expectations. And Amex is so interesting to look at because they do have that wealthier clientele, right? So it feels like a good indicator.
Got to pay it at the end of the month, unless you get, I know they have other cards, right, that you can kind of spread it out. But nonetheless, you're right. They play to certainly folks that tend to be, part of our wealthier segment of the population. What's interesting is the chief executive out in a statement saying our customers have been resilient thus far in the face of slower macroeconomic growth, elevated inflation, and higher interest rates. That said, we're mindful of the mixed signals in the external environment. So I'm curious if he means just mixed signals generally or mixed signals that they are seeing as well.
That's right. Well, it's so interesting too because it does feel like they're giving us mixed signals, right? Like deposits are good for them. The CFO saying that as you think about all the deposit flows, clearly we're the winner. He said in a phone interview with Bloomberg, deposits are great, but they're worried about these loans souring.
Yeah, exactly. And it's interesting. So, provisions for loan losses above $1 billion. JP Morgan and Citi also grappling with a surge in write-offs. So this is coming after years of record low losses on card loans when consumers were aided by all the stimulus, the pandemic stimulus, and they were at home not spending money generally, like going out and doing things. So, their own personal bank accounts got a lot fatter and put them in a better case. They were actually paying down credit card debt.
Right.
And this talks and shows a little bit of a different story.
Yeah, more and more people spending for everyday items using their credit cards for that. That is just not a good sign for the health of the American consumer.
Yeah, shares of Amex still up about 10% so far this year. All right, time to head over to our TV colleagues. Our cross-platform coverage, Beyond the Bell. Market close happens now.
Investors, stick with us, moving closer to these closing bells. Full market coverage right here on Bloomberg as we take you to the bell and beyond.
Beyond the Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostic alongside Scarlett Fu. We're counting you down to the closing bell. Here to help take us beyond the bell. It's a global simulcast, joined right now by Carol Messer and Maddie Mills. Welcome to our audiences across all of our Bloomberg platforms, television, radio, originals, and those folks streaming on YouTube. Down about 0.7% on the S&P 500, about 1% here on the NASDAQ composite. Carol Messer, interesting price action today, despite some earnings that actually weren't all that bad.
Yeah, it is interesting. It does feel like there's some malaise in the market environment, certainly on the equity side of things, a bit of a lull here. Having said that, those home builders really some outperformers, right? Up about 2.3% here, up more than 4% at their highs. What?
Yeah, this is like one of those industries where I've been waiting for the collapse. And it just completely defies it.
I can never make sense of, we have too many homes, we don't have enough homes. D.R. Horton, though, is really a big reason for the catalyst in the home builders today because their second quarter results topped expectations, and their orders numbers really was outstanding here.
Well, what's so interesting about D.R. Horton, I know you're going to talk about this a little bit more, Carol, but they showed that new home sales were a little bit light, but showing still a resilient market, right? So this is just another big question that I have is what are we seeing on the housing market here, Scar?
Yeah, but there's a lot of idiosyncrasies with the housing market in that supply is limited and people are holding onto their homes or they can't get the mortgage rate that they want to get with rates climbing. Right. The bigger picture that the economic data paint today is really one that shows the economy is slowing down, right? Jobless claims rising to the highest since November 2021. So the labor market is losing momentum.
Yeah, I mean, a lot of people are making bets here, and we talk about what we saw a little bit earlier in the commodity space with another dip down here in WTI crude. We should point out WTI crude has now actually erased all of those gains that it had coming off of that OPEC plus surprise production cut announcement. Meanwhile, back to the equity markets here, the Dow Jones Industrial Average lower by more than 100 points, or about 0.3%. The NASDAQ Composite down about 100 points, or 0.8%. The S&P 500 lower by about 25 points, or about 0.6%. Meanwhile, the Russell 2000 down by about 10 points, or about 0.5%.
All right, despite markets finishing off their lows of the session, but as Romain mentioned, down across the board, those major equity averages, most names in the S&P 500 lower today. Scarlett down 327 names in total, 172 showing some gains, 4 unchanged.
And the declines, if you look at the sector performances, really are concentrated among those that are leading to the downside. Autos and components are the big losers of the day, off by 8%. That is really dragged down by Tesla. You've got telecom companies, AT&T, for instance, getting a disappointing reception to its latest results on free cash flow. And banks also lower by 1.2%. Your best performers, some defensives, right? Food and staples up by 0.8%. Consumer durable and apparel also higher modestly by 0.2%.
All right, folks, let's get to some of the individual gainers, if we may. Top of the S&P 500, number 3 gainer in the S&P 500 is D.R. Horton, climbing to its high since December of 2021. As we just mentioned, second quarter results topping expectations, and we also just saw really some outperformance when it comes to orders. Orders were up 73% from the previous quarter. Talk about outperformance. It really raised the overall group, including Lennar, KB Home, pick your name. Lam Research, number 1 in the NASDAQ 100, number 2 gainer in the S&P 500. Semi-capital equipment company. Analysts are pretty positive after it reported third quarter results that beat expectations. We got that after the close yesterday. Did give an outlook that was weaker than expected, but Wall Street firms writing that the reports point to a bottom ahead, so we could see some bottoming. So you had KLA Tencor, Applied Materials also rallying in top of the NASDAQ 100. One more, Costco. It was up about 2% in today's session, top of the NASDAQ 100. Remember, after the close yesterday, raising its quarterly dividend to $1.02 from 90 cents a share. So that's more than a 13% hike. Company reporting in about a month. So just want to mention D.R. Horton for the radio guys, up 5.6%. Lam Research up more than 7%.
And I just want to add another one to the day.
Please.
We don't talk about it. Snap-on, of course, a big tool maker. They make a lot of diagnostics equipment for mechanics and things like that. Shares were up 8% here on the day. That was one of the bigger movers in the S&P as well. And maybe that's a sign that not all is wrong with the economy right now.
Yeah, well, I'm going to bring it back down for us, Romain, because today was the big regional banks day. I'm going to focus on those for our decliners. The S&P 500 regional banks group down by about 3% on the day, starting with Key Corp, starting with American Express, rather, actually. They are down by 1% at the close. I feel like they're so interesting to look at because they do have that wealthier clientele. They were one of the worst performers in the Dow Jones on the day. Earlier today, provisions for loan losses at Amex topped $1.1 billion. That was well over what analysts were expecting. And shares were up 11% through yesterday. So this is the market maybe punishing them a little bit, coming down from those rosier expectations that we had yesterday. Then going back into Key Corp, down by 2.75% on the close. Net interest income was below expectations. They expected an increase this year, and now they are saying they're expecting a decline. And then I want to look ahead to First Republic. We're getting those earnings on Monday, but down 1.7% on the close. On all of the news that we're getting in about those regional bank earnings. So the big picture here, does this performance represent a slow bleed for any type of credit lending that we're seeing for American consumers?
Yeah, and just another one to add to AT&T shares are down about 10% on the day. Biggest drop that we've seen going back to the year 2000, to be specific here. And we were talking about this a little bit earlier here, just the idea that when we talk about the moderation in that wireless segment and what we're going to hear out of some of those other companies as well. Let's turn to the yield space real quick here, because we did see a lot of buying in the bond space today, particularly when it came to treasuries. That actually pushed yields down by at about 9 basis points on the 2-year yield, still camped out above 4%. On the longer end of the curve, we saw moves of about 4 to 5 basis points lower on the 10, 20, and 30-year yield. Some other breaking news that was crossing the wire, this also on the Treasury, and more importantly, on the Treasury's cash pile. That cash pile now rising to about $265 billion as of April 19th, as those tax receipts start to trickle in. A little bit of context here, we should point out about a year ago, that cash pile was over $1 trillion here. Of course, the debt ceiling and, well, the lack of a compromise on that really constraining the ability of the Treasury to raise funds here. And so still a lot of concerns here about how much longer they have to go. Earnings also crossing the wire, Scarlett.
Yeah, I'm taking a look at CSX, the railroad company, and the shares are moving higher in after-hours trading, up about 2.5% after its earnings beat analyst estimates. Whether you're looking at revenue, which came in at $3.71 billion, better than the $3.6 billion expected by analysts, or on the bottom line, 48 cents was the EPS. Analysts were looking for a nickel less at 43 cents. Operating income also increased about 14% to $1.46 billion. And it's in contrast to what Union Pacific had reported. Although it did top analyst estimates on higher prices, there were some concerns about the challenges ahead as well.
Yeah, I'm looking at the press release from the president and CEO making some comments. They talk about CSX having an encouraging start to the year as the efforts of our dedicated railroads resulted in strong earnings growth. Yeah. They talk about lifting their service performance, providing them with exciting opportunities. You know, Romaine, it feels pretty upbeat and optimistic at this point.
Yeah, absolutely. Here, I do just want to just go to another earnings report crossing the wire. This is Bank OZX, formerly Bank of the Ozarks, one of those regionals that under normal circumstances we probably wouldn't pay much attention to. But of course, everyone focused now on those deposits, and deposits in the period did actually end at about $22.28 billion, which is pretty much on the nose of what the street was looking for. Now, that is a decline, but it is not declining more than what the street was looking for. Similar numbers here on net interest income, net interest margins, as well as average equity, all coming in at or slightly above what the street was looking for. And we are going to speak a little bit later in the program with the CEO of Bank OZK a little bit later.
Yeah, George Gleason will be joining us in the next hour or in the next 30 minutes. But I want to go back to that point about how everyone's focused on regional banks and where deposits are sitting, because there's been a lot of money, Romaine and Carol and Maddie, that have moved to money market funds. But we did get data that show that actually the amount of money parked at U.S. money market funds plunged last week, the most in 2 years. Anyone care to guess why? Tax day. People were taking money out to pay for their tax bills. Makes sense.
Well, it makes a lot of sense, and it's just so interesting that we've been talking about this U.S. Treasury.
Scarlett, you can't ask pop quizzes of
Yeah, that's Romaine's move, Scar. Come on. We were talking about
I think she's only gotten one of my pop quizzes right in 2 years.
I've got a couple of your pop quizzes, right?
I may be exaggerating.
I like the
pop
quiz.
quote.
Can I go back to Bank OZK for a moment?
Yeah.
I'm reading the press release. Provision for credit losses was $35.8 million for the first quarter of 2023 compared to $4.2 million for the first quarter of 2022 and $32.5 million for the fourth quarter of 2022.
Okay. Well, I mean, look, this is what we're talking about. And we were talking a little bit earlier about Brian Moynihan sat down with David Weston at the Bloomberg Sell Side event. And a lot of this conversation is the same here, right? It's that, yeah, there is softness there. Yes, provisions are going up, but overall, they're still seeing relatively healthy trends.
Yeah. And he did say the economy is slowing down. The Fed tightening is having its intended effect. Loan demand is slowing down. This is what you expect to see. It's not the same, though, as what we had in 2008. It's not even the same as what we had in the late 80s, early 90s. He called what happened a disruption. That was the word, right, Romaine? Not crisis.
A disruption here. But we are still, of course, in a situation where the economy still has to be doing. I'm looking at the terminal now, guys. I mean, Clorox announcing about a 4% reduction of its non-production workforce here. You've also got some other job cut news coming from other companies here. So you still have some folks still kind of trimming around the edges, I guess in anticipation, maybe, of that slowdown?
I think that's exactly what it is. I think companies, when they can have an opportunity to cut costs, whether it's through attrition, letting people go, they're going to do it to get ahead of it. It just feels that way, but we will certainly hear more as we work our way through the earnings season. All right, guys, that's a wrap. The Thursday cross-platform coverage, radio, TV, YouTube, and Bloomberg Originals Beyond the Bell, counting you down to the close on this Thursday. We'll see you again, same time, same place tomorrow. world today. Shares of Tesla, as we talked about, really impacting the market trade, the overall market trade today. Tesla shares alone, let me just pull it up for everybody, down almost 10%, so finishing just off their lows of the session and definitely shaving quite a valuation, if you will, off the market cap. Tanking, as Elon Musk said, Tesla's going to keep cutting prices to stoke demand, even after markdowns early this year took a significant toll on profitability. We'll get into their operating margin. You know, you've been hearing about that a lot. That news was last night, and then this morning, SpaceX attempting to send its Starship system into space, and then it exploded. We have some details on that. So let's get into it with our Bloomberg News EV reporter, Sean O'Kane, with us on Zoom in Austin, Texas, and then also with us is Bloomberg News space reporter Lauren Gresh. She's on site in Texas near where the rocket exploded earlier today. So our thanks to both of you. Sean, I do want to start with you, though, because the news out of Tesla last night, what we got in the earnings release, and then what Elon had to say on the call with analysts definitely moved the stock price. What do you think, here we are, 24 hours in, really is the key takeaway from what Tesla had to say?
Well, I mean, the bottom line is that the automotive gross margins, when you pull out leases and you pull out regulatory credits, were under the target that Tesla's CFO, Zach Kirkhorn, had forecasted on the last call back in January. He basically said, hey, you know, because that was right around, they had started making the really drastic cuts. They had already implemented price cuts at the end of last year in anticipation of, you know, all the questions about who was going to qualify for IRA credits and whatnot. And so he had said, hey, you know, we have industry leading margins. We're going to be able to take a bite out of those with some of these cuts to keep demand up. And we don't think it's going to go under 20%. But after they released the numbers last night, it seems like most analysts were able to work out that automotive gross margins, excluding those items, were closer to 18%. So even he was willing to admit on the call that was lower than they expected. And that was a result of continuing to make cuts from the time of the last call to now, and also some other issues like some changes to the warranty on older vehicles and things like that. So I think that's the biggest thing. I think the other biggest thing is that it doesn't sound like they're done. Elon Musk seems like he's eager to take advantage of the fact that they still have more margin to go that they could eat into if they wanted to continue to drop prices.
So, Sean, can you talk to me about that automotive gross margin number? Because it typically is just included in the earnings report, but analysts had to crunch the numbers this time around. Was that notable to you?
Yeah, that was the first thing that jumped out at me because it was the first thing I was looking for, like many other people.
We were all word searching for it, right?
Yeah. It's usually right up top in that first entry of the earnings report, and so it was very obvious right away that it wasn't going to be there and that it was going to take a little bit of math. Lost. I'm not terribly surprised at that. I mean, one of the things that Tesla's CFO said last quarter was that, you know, he gave those predictions about a 20% automotive gross margin and a 47,000 average selling price across all their models, and he was sort of forecasting that. But he also said right after that, hey, just so you know, we care more internally about the operating margin. We hope that's something that you'll consider as you go forward. So that they de-emphasized automotive gross margin, I guess to put it nicely, didn't really come as a surprise. Although his favored metric, operating gross margin, was down pretty severely, down to 11.4%.
Right.
When a year ago it was in the 19s. So they call that a manageable decline. I think a lot of other people were sort of trying to factor that in today as we saw the stock drop a little bit.
Yeah, absolutely. I mean, still up 32% this year, but definitely a big haircut. Hey, Lauren, come on in on the story of all things Elon. Starlink, what exactly happened?
Right. So it's the Starship spacecraft that
Starship.
Elon,
sorry.
Yeah. Yeah. No. It's actually quite confusing because they put the word star in front of everything. I think. But yes, it's Starship, and it's their deep space rocket that they're hoping to use to send humans to deep space, like the moon and Mars. And they tried to launch it on its first test launch today. Unfortunately, you know, it did achieve some air, but ultimately it did explode at about 4 minutes into the flight. So, you know, they definitely got a lot of data from it, but you know, didn't end the way they expected.
Exploded, or they exploded it?
So they exploded it. So we just learned recently. We were questioning for a minute whether or not it exploded on its own, maybe from aerodynamic, you know, pressures or forces on the vehicle. But it turns out that once the Starship rocket was going off course, it was if you looked on the live stream, you could see that it was kind of twirling off course, tumbling wildly in the sky, and then eventually SpaceX revealed that they activated the flight termination system, which is used to blow up the rocket so that it, doesn't, it ensures that it does not harm any uninvolved public or property.
Well, Lauren, I want to stick on some of the good news that we got for SpaceX today. And you have an amazing piece on this. Everyone should go read it. I was blown away that you were able to change the intro so quickly based on the news, because it's such a great piece on the terminal and online. Talk to me about the wins for SpaceX today.
Absolutely. And you know what? That is just what space entails, right? There's always wins. That you have to always be flexible, because you never know how these things are going to turn out. But yes, some great wins today. I mean, this was the first test flight of the fully stacked Starship rocket. So Starship consists of two main parts. It's the Starship vehicle, which carries the cargo, the satellites, the people. That's the top of the rocket. And then the bottom of the rocket is the Super Heavy booster. And that's what's needed. It has 33 Raptor engines on its base, and it's used to break free of Earth's gravity and propel Starship to space. And this was the first time both of those pieces flew together, stacked on top of each other. So that is a major win for SpaceX. They were able to actually clear the launch pad, achieve the highest altitude I think they've ever done with this vehicle, and they were actually able to show that Super Heavy can fly. So unfortunately, they had some engine out issues. Not all 33 engines actually ignited, and some of them flamed out during the flight. And then obviously there were some control issues in the sky, but definitely a major win, and SpaceX is taking it a major win. I don't know if you can hear behind me, but I'm out at a party where everyone is celebrating right now, because they are so happy that this thing actually left the launch pad. So it's actually, SpaceX is definitely seeing it as a win for sure. They can use the data to incorporate it into future flights for sure.
All I could think of is what did that cost? I'm going to go back to the business side of the story. Sean, come on back in here. What other color can you give us in terms of what we heard and what kind of Elon we got on the analyst call?
Well, it was. I think it's funny that we get him every time now, despite him saying a couple years ago that he was going to stop doing these things. But he still seems pretty obviously involved in the day to day there, despite having a lot on his plate this week. Whether that's the business of Twitter and trying to keep that afloat, and also launching a piece of technology into the sky that had never launched before in the Super Heavy booster. So, it was interesting to hear him talk. I think the thing that really stuck out to me the most on the call and from Elon himself was that in talking about the ability to eat into those margins as far as keeping competitive pressure up, he's talking about he thinks Tesla could actually go to zero profit on its cars, which is an outrageous thing to say, because he so fully believes in the ability of his company to deliver on this promise that they've been promising for years of being able to make its cars fully autonomous, that he thinks they could actually sell these things at a wash in the near term and recoup any of that lost profit down the road if they were able to roll out full self-driving as an actual feature that people want to pay for and that is so revolutionary that it would get,
Can I see self-driving technology first, though, Sean? Come on.
I mean, a lot of people take that same approach. I think we want to know for sure that it's possible. And he even explained last night he views it as a two-step forward, one step back problems at this state.
We got to run. Sean and Lauren, thank you so much. This is Bloomberg Radio.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 4:21 on Wall Street. We do check markets all day long here at Bloomberg. Developing story, Wall Street Journal now reporting that Whole Foods Market planning to cut several hundred corporate jobs. The Journal says the grocer is reorganizing its structure to simplify operations. Amazon, the parent company of Whole Foods, lower today by 0.5%. Down day on Wall Street. We did finish off session lows, but nonetheless a down day for the Dow, the S&P, and NASDAQ. S&P down 24, dropped today of 0.6%. The Dow down 110, down 0.3%. NASDAQ lower by 97, a drop there of 0.8%. Wall Street's fear gauge, the VIX, has been subdued, but Amy Wu Silverman at RBC Capital Markets says that may be about to change.
When you look at the activity kind of under the surface, there's been a substantial amount of VIX call buying, essentially telling you that they think in the future we're going to see a lot more volatility.
10-year yield, 3.53%. The 2-year, 4.14%. Spot gold up $10 the ounce at $2,005, up 0.5%. West Texas Intermediate crude down 2.4%, $77.29 a barrel. After earnings, Tesla shares down today by 9.7%. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
All right, Charlie, thank you so much. Carol Master along with Madison Mills live in our Bloomberg Interactive Brokers studio. So another decision coming tomorrow on abortion pill limits as the Supreme Court extended a temporary hold on new restrictions on those pills, those restrictions imposed by a federal judge in Texas.
And now justices have until tomorrow to decide what to do with this case. This comes after the Biden administration and Danco Laboratories, which is the maker of the drug, requested that any restrictions get put on hold while this legal battle continues. A lot of moving parts. So here to discuss the impact of that battle is Dr. Suzanne Bell, assistant professor in population, family, and reproductive health at Johns Hopkins Bloomberg School of Public Health, which I should mention is supported by Michael R. Bloomberg, founder of Bloomberg LP and Bloomberg Philanthropies. She's on Zoom with us from Baltimore. Dr. Bell, great to speak with you, and thanks for being here. I know we've been back and forth on this case for a couple of weeks, but what do we know right now about the impact that it's already had in terms of access to this pill?
Yeah, so right now it's just introducing a lot of uncertainty in the states where abortion is still legal, and providers are kind of just in a waiting game right now for this decision, with a lot of potential clinical implications around the provision of medication abortion, which is currently more than half of abortions in the U.S.
What does it mean if women don't have access to this pill going forward, ultimately?
Yeah, I mean, I think much to the chagrin of the people who brought this case, this will not stop medication abortions from occurring. It is just really another attempt to interfere with the delivery of evidence-based healthcare and control pregnant people's bodies. Providers will instead be forced to use a misoprostol-only regimen instead of the more effective combined regimen with mifepristone, which simply means that pregnant people are going to be exposed to more uncomfortable and potentially severe side effects that are very uncomfortable, but ultimately this is an incredibly safe and effective regimen. So it's really just a matter of interfering with the science when in fact we have evidence from more than 100 peer-reviewed rigorous studies showing that this medicine in combination with misoprostol is highly effective and safe for terminating pregnancies.
Okay, talk to me about the evidence here. I'm so glad you bring this up because one of the nuances of this case for those of us who are not doctors is this question about FDA approval that the judge in Texas brought up. Can you explain that to me? Is there any reason from your perspective to be concerned about the FDA approval of the abortion pill?
Absolutely not. You know, the FDA is a very conservative, independent agency full of scientists that know how to evaluate the science. And we already had almost about 14 years of approval in France where the medicine was developed before the FDA even approved it in 2000. And since then, we have approximately 80 countries around the world who have also approved this medicine. We have decades of safety and effectiveness evidence from around the globe indicating that this is an appropriate approval that the FDA provided more than 20 years ago. And, you know, in the intervening years in the U.S., hundreds of thousands, if not millions, have used this drug as part of their termination of a pregnancy. And so there's really no legitimate claim here around safety and a lack of evidence around mifepristone.
So what are the conversations you guys have been having at Johns Hopkins around this?
I mean, I think it's really frustrating. There's a lot of frustration among clinicians, among social scientists doing work in this area, because it's really just another way in which there are increasing barriers to the ability for people to self-determine and actualize their reproductive goals. This is just going to be another impediment, and people will work tirelessly to reduce the impact of those barriers. But really what we know from the evidence is that the more barriers you put in place, the more disadvantaged populations in particular are negatively impacted by them. And that is going to have, significant long-term health, social, financial implications for the people who ultimately aren't able to obtain a wanted abortion, whether it be medication or procedural, in light of the fact that this is happening in the backdrop of Dobbs and 26 states banning or severely restricting abortion in those parts of the country.
Suzanne, let me just jump in. And you say that it'll for those who it might be more difficult for them to obtain an abortion or I'm just curious though, if the one pill is still available to everyone, how does that then maybe appease some of the impact on those numbers?
It will definitely reduce the likelihood that this is going to negate one of the options for people that are seeking abortion. I think it's just trying to situate this in the context of the much broader abortion landscape that we're sitting in right now in the U.S. This is just a way in which you will further, erode access to safe, effective medication abortion. Misoprostol is the misoprostol only regimen, like I mentioned, is still incredibly safe, slightly less effective. So you will expose people to slightly more, potential for an incomplete abortion. And so I think the claim in the lawsuit brought is really a farce, because they claim to be concerned about the discomfort of medication abortion and the risks associated with medication abortion, and not wanting to treat people in an emergency room that are suffering from medication abortion complications, when in fact less than 0.5% of all medication abortions result in a complication requiring hospital-based care. It's incredibly safe. And in addition to that, I think it completely negates the fact that pregnancy is incredibly risky. The risk of maternal death for a person whose pregnancy ends in a live birth is 15 times greater than that of safe abortion.
Wow.
It's such an important data point. And I also heard you mention earlier, which I hadn't heard before, that doubling up the second dose misoprostol, we know that that's a backup plan if this does go through. But is it more painful for the patient? Does it cause other potential difficulties beyond potentially not being as effective? Does it also cause potentially more discomfort than the current regimen?
Yeah, that's exactly the case. It's really that, the misoprostol only regimen is used actually in many parts of the world where mifepristone is not registered and is still effective and safe. It is a WHO recommended means of safely terminating a pregnancy, but it causes more uncomfortable side effects, nausea, vomiting, more severe cramping. So it's really just unnecessarily exposing pregnant people to more discomfort and more severe side effects, diarrhea, chills, and intense nausea that could be avoided if first taking the mifepristone tablet followed by a lower dose of misoprostol.
I'm going to steal a question that Maddie actually had in our notes, and this is, if you could testify, what would you want to tell SCOTUS about the impact of a move to ban something like the abortion pill? Because I think it's just a super smart question.
Yeah. Well, thankfully, I am not on the spot there in front of SCOTUS. But I think as a researcher, as a scientist, I think it's really important to respect and acknowledge the science. And right now, the evidence is unambiguous. We have more than 100 rigorously conducted scientific studies from countries all over the world over the past 3 decades, plus demonstrating the safety and effectiveness of mifepristone for medication abortion. So this decision from Kaczmarek in Texas was clearly ideologically motivated. And there's, like I said, really no ambiguity around this. I think it would be a real travesty to have the courts intervene with this independent agency's ability to approve and regulate medicines from the perspective of the science here in the U.S.
And in like 30 seconds here, are you concerned at all about the implications this case could have for the FDA moving forward at all?
I mean, yes, I think this is a really dangerous precedent to establish that a court and any entity could bring a case against a drug maker, against a specific medicine that has gone through the rigorous vetting process that the FDA already has, that is genuinely effective and conservative, and especially with a drug like mifepristone that actually has a higher standard of safety and efficacy. So I think it would be really dangerous for the courts to move in that direction.
Well, so appreciate getting some time with you and just laying it out from a scientific and medical perspective and understanding potentially the impact. Suzanne, thank you so much. Dr. Suzanne Bell, she's assistant professor in population, family, and reproductive health at Johns Hopkins Bloomberg School of Public Health, as you know, supported by Michael R. Bloomberg, founder of Bloomberg LP and Bloomberg Philanthropies. Dr. Bell joining us via Zoom from Baltimore. So we'll know more in roughly 24 hours from now.
Yeah, hopefully.
I guess they can take it down to midnight, I guess, ultimately. I think.
Well, and I feel like it goes all the way to the Supreme Court. At least that's what our expert reporters have told us. So I feel like this is going to be a conversation for a while, Carol, but such a great expertise coming from her on that.
Absolutely. All right, let's get back to world and national news. Certainly this is on the mind of our news anchors. Let's head off to Nancy Lyons. She's in D.C. Hey, Nance.
Thanks, Carol. Treasury Secretary Janet Yellen says the U.S. is ready to bear the economic cost of confronting threats posed by China. In a speech in Washington today, Yellen says national security is of paramount importance in the U.S.-China relationship.
These national security actions are not designed for us to gain a competitive economic advantage or to stifle China's economic and technological modernization.
Secretary Yellen says she plans to visit China at the appropriate time. An IRS special agent is seeking whistleblower protection so he can disclose information about what he alleges is the mishandling of an investigation into President Biden's son, Hunter Biden. Mike Lytle is attorney for the whistleblower and says he's written to lawmakers saying his client has information to help them in their oversight duties. He spoke with ABC.
He's lost sleep over whether to come forward. And, you know, at the end of the day, he's decided that he would feel worse about himself if he did nothing and stayed quiet.
Attorney Mark Lytle. Hunter Biden has been under federal investigation since at least 2018. So far, no charges have been filed. The White House says the president has upheld his commitment that the investigation would be handled independently by the Department of Justice. Manhattan's district attorney has notched a legal victory in his bid to keep Congress from investigating his case against former President Trump.
An appeals court is temporarily blocking congressional Republicans from enforcing their subpoena for Mark Pomerantz. He is the prosecutor who resigned from DA Alvin Bragg's office last year out of frustration over the slow pace of the hush money probe into former President Trump. Pomerantz later wrote a book about his experience. The House Judiciary Committee, led by Republican Jim Jordan, had hoped to question Pomerantz today. In Washington, I'm Nathan Hager, Bloomberg Radio.
Global news 24 hours a day. I'm Nancy Lyons.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 4:40 on Wall Street. We do check markets all day long here at Bloomberg. We begin with a developing story and a headline from the Bloomberg Professional Service. Fed says its emergency bank loans rose to $143.9 billion from $139.5 billion in the prior week. Tech led stocks lower today. Tesla shares tumbling about 9.7%. As for the mood of the market, Marianne Bartles is chief investment strategist for Sanctuary Wealth. She was a guest right here on Bloomberg Business Week.
The market has really been range bound, and those are frustrating markets because it really doesn't feel like a trend, although technically we're slightly in an upward bias. So the range has been 4,200 on the high end. We haven't been able to break above that. And I would say there's good support around 3,800.
And right now the S&P 4129, indeed down by 24 points today, down 0.6%. The Dow down 110, down 0.3. NASDAQ today down 97, a drop there of 0.8. 10-year yield 3.53%. Spot gold at $2,004 the ounce, up by 0.5%. West Texas Intermediate crude down 2.4%, 77.29 a barrel. President Biden's Inflation Reduction Act is rubbing European business the wrong way. It is stoking fears that incentives in the law could pull more investment away from Europe and into the U.S. And we spoke with Ireland's finance minister, Michael McGrath, about the matter.
The simplicity of what the United States are doing, that essentially the support to the tax system is cash back, and it's difficult for Europe to compete with that. So I think we have work to do to calibrate an appropriate response.
McGrath was a guest on Bloomberg Daybreak Europe. Catch the full interview on tomorrow's program and on demand on the Daybreak Europe podcast. Railroad CSX reported earnings per share for the first quarter that did beat the average analyst estimate. CSX higher after hours, up by roughly 2.5%. Recapping stocks lower today, the S&P down 24, down 0.6, and that is a Bloomberg Business Flash.
All right, Charlie, thank you so much. Well, remember when every day it felt like we were talking about another slew of companies going public? I mean, it's a really different environment.
Yeah, it feels like those days are feeling foggier and foggier, both on the IPO side and the SPACs side. Right?
Yeah, absolutely, right. And a lot of it is to do with, what's gone on in rates and just a market that's a little bit more nervous. So let's get to it. And I was looking at actually the Renaissance IPO index. It's up about 14% year to date. So that was kind of interesting, despite some of the hesitation. So you want to get to the IPO market?
Let's get to it. We've got Rachel Gehring, EY America's IPO leader, joining us on Zoom from Nashville, Tennessee. Rachel, thank you so much for joining us. I know that EY recently released its Global IPO Trends Report for the first quarter of 2023. Broad picture here, what's the headline from the report?
Well, happy to be here, and thank you for having me. And just as the two of you were commenting a moment ago, definitely it's subdued out there, to say the least. We ended the quarter with 33 IPOs in the U.S., raising roughly $2.5 billion in proceeds. Another 11 companies have since come to market since the end of the quarter. So generally, we're in line with this time last year, but well below levels we've seen in comparable periods over the past decade.
Yeah, it doesn't feel like there's a lot of enthusiasm. I feel like I can't remember the last time there was anything in a conversation about, we're looking forward to these companies going public. What's the outlook, Rachel, or what kind of visibility do you have about maybe what's coming in the later half of the year and maybe into 2024?
Yeah, I would say there's definitely continued strong interest from companies. So the pipeline, the shadow pipeline, that is building. There's, points of optimism there. But in terms of the immediate, coming into Q2, I'm not predicting a whole lot of additional activity, just given the macroeconomic factors that is impacting all companies out there. And it's going to continue. You mentioned nervousness. That's certainly still there. Lack of stability and so forth. So companies are definitely in that wait and see, waiting on the sidelines, waiting for the markets to reopen, but certainly several companies out there who are readily preparing for that opportunity.
So where do you see the biggest factor for optimism when it comes to the IPO market, and when do you anticipate that optimism kicking back in?
Yeah, great question. And I wouldn't say there's one single factor. There's several factors that we are keeping a close look and following closely. Inflation readings, definitely one. Interest rate hikes, as you previously mentioned, and where the Fed stands on interest rates. Market volatility, that's been working in our favor. Frankly, in Q1 we had 3 days in the quarter where the VIX was over 25. That's in that kind of no-go zone, if you will. Whereas 30 days this time last year with the VIX over 25. So there's promising signs relative to volatility, but we still need continued stability there. Growth stock performance needs to continue to improve so that it starts attracting investors back to the IPO product.
Yeah, it's interesting. I wonder, in terms of breaking it down a little bit more, either geographically or by sector, how does that break out?
Right now, it's the law of small numbers, to be frank. I mean, in terms of volumes and then proceeds raised, with those numbers I was sharing earlier, 8 of those deals were IPOs raising over 50 million. So that just gives you a context of the size of the deals happening right now. Very small. 15 of the deals were companies based in the U.S. So large majority coming in from outside of the U.S. So the deals right now are small. They are led by, continue to be led by tech and life science sectors, but they're just not the large deals that we're used to seeing. Seeing some optimism and some uptick in the energy sector, industrials, consumer products. So it's kind of across various sectors that we're seeing the activity right now.
Yeah. Well, Rachel, I was going to stick on the global question for a second because I'm just back from Dubai, where every day there was a big story about IPOs because you don't pay taxes there. It's big on oil, and there's a lot of opportunity, and the interest rate environment is completely different. Are you seeing big picture and longer term that the IPO market turns to countries like that, to cities like that, and out of the U.S. where it's just a little bit more volatile and there are more headwinds to deal with?
Despite the headwinds we're facing here in the U.S., it's still very much an attractive market. So the quietness that we're seeing and experiencing right now, hopefully we start to see some of that unlocking and more activity here in the U.S. late this year is our hope, certainly into 2024. In the meantime, are we going to see some promising deals outside of the U.S. in some major markets? Absolutely. But I don't think that's necessarily indicative of activity largely going away from the U.S. long term.
Although, what's interesting, I was just doing kind of an NI IPO search on the Bloomberg, and it looks like there's a fair amount, of activity over in China. I am curious, are we seeing, China certainly pick up their momentum, and is it possible that IPOs, we're going to see a lot more activity that aren't, United States or U.S. based?
Yeah, we'll continue to see some promising deals outside the U.S. With ongoing kind of geopolitical tensions and regulatory moves, so forth. I think we will see more deals in China. But again, I expect our volume here in the U.S. to hopefully pick back up. Again, I think it's late this year, though. I don't know that it'll be Q2.
Yeah.
Hopefully later in Q3 into Q4, and then certainly hopeful and optimistic about 2024.
All right, going to leave it on that note. Hey, Rachel, thank you. Rachel Gehring, IPO leader at EY Americas, on Zoom from Nashville, Tennessee. And Maddie, I'm just looking at the terminal. Alibaba's grocery arm gearing up for a Hong Kong IPO. You have a Chinese chip maker seeking an IPO with a value of over $14.5 billion. That was earlier. That was overnight from Asia. Ant Group IPO likely this year, one venture capital firm saying. So that's a lot of activity out of Asia.
Yeah, and I think...
Or it feels like market.
Well, it's such an important point that maybe investors and companies and entrepreneurs are just leaning more global and seeing more opportunity in places like China, where the environment is just different.
Yeah, exactly. So we'll see whether or not stuff starts to pick up in the U.S. later on. All right, you are listening and watching Bloomberg Business Week right here on Bloomberg Radio.
Your company news headlines on Bloomberg Radio.
It is 4:53 on Wall Street from Bloomberg World Headquarters. I'm Charlie Pellet. Clorox is implementing a second round of layoffs, eliminating 200 positions as part of a reorganization aimed at reducing costs, launching products more swiftly, and adapting to consumer preferences faster. Amazon's Whole Foods market grocery chain plans to lay off hundreds of corporate employees, all a part of a reorganization, this according to the Wall Street Journal. BuzzFeed shutting its news operation and business news publisher Insider cutting about 10% of its staff in the latest signs of retrenchment in the digital media business. Truist Financial and Fifth Third Bancorp reported deposits that were broadly stable in the first quarter. And with more on the regional banks, here's Bloomberg's Denise Pellegrini.
Charlie, deposits at Truist stood at about $408 billion as of the end of March versus predictions for about $411 billion by analysts tracked by Bloomberg. And that compares with $413 $418 billion by end 2022 and $415 billion a year earlier. Over at Fifth Third, average deposits coming in at around $161 billion. That's also roughly flat compared to the end of 2022. At Comerica, deposits came in at $64.7 billion. That missed estimates in a sign the turmoil took more of a toll. Of course, regional banks, Charlie, have all been roiled by the March collapse of Silvergate Capital, Silicon Valley Bank, and Signature Bank.
And that's Denise Pellegrini. Today, Truist down 3.8%, Fifth Third down 0.6%, Comerica down 2.7%. Those are our top business stories. This is Bloomberg.
This is Bloomberg Business Week with Carol Masser and Tim Stenevec on Bloomberg Radio.
All right, y'all, we've got more Business Week to come. I'm Madison Mills here with Carol Masser. We're on a quick coffee break, but we're going to give you a check on the latest world and national news with Nancy Lyons in D.C. Hey, Nance.
Thanks, Madison. As she prepares for a not yet scheduled visit to China, Treasury Secretary Janet Yellen today laid out the Biden administration's comprehensive China policies in a speech at the Johns Hopkins School of Advanced International Studies.
Yellen said expanded support for state-owned enterprises aims to disadvantage American competitors, but it's stunting China's economic growth.
We do not seek to decouple our economy from China's, and we will not hesitate to defend our vital interests. Even as our targeted actions may have economic impacts, our goal is not to gain competitive economic advantage.
Yellen reiterated that any Chinese aid to Russia's war effort would have serious consequences. She did not mention the threat to Taiwan. In Washington, Irv Chapman, Bloomberg Radio.
Republican leaders are celebrating the passage of a House bill to ban transgender women and girls from participating in female sports. The measure that passed along party lines would prohibit schools and other entities receiving federal funding from allowing biological males to compete in female athletics. House Majority Whip Tom Emmer.
Vetoing this bill, as Joe Biden has threatened to do, would be a slap in the face to women's rights, science, and common sense. But in a House Republican majority, we're going to make sure the female athletes are given the fairness, safety, and opportunities they deserve.
Emmer says the left's lunacy, those are his words, are robbing women and girls of equal opportunities. House Minority Leader Hakeem Jeffries says Republicans just want to bully transgender kids. Manslaughter charges have apparently been dropped against Alec Baldwin related to the on-set death while filming the movie Rust. A statement from Baldwin's lawyers say they're pleased with the decision and they encourage a proper investigation into the facts and circumstances of what happened. The film's cinematographer was accidentally killed by a prop gun that was held by Baldwin. Global news 24 hours a day, powered by more than 2,700 journalists and analysts in over 120 countries. I'm Nancy Lyons.
All right, Nance, thank you so much. Carol Masser, along with Madison Mills, live in our Bloomberg Interactive Brokers studio, streaming on YouTube, kind of piggybacking off of what Nancy said and referencing Treasury Secretary Janet Yellen, who said that the Biden administration was prepared to accept economic costs as it sought to protect U.S. national security interests from threats posed by China, even as she appealed to Beijing to cooperate